terms of the soft landing playbook, that's still up in the air.
We do think that we're going to see more of a soft patch.
I think it's important to recognize that the balance of risk has shifted when we talk about rates.
I think every meeting is open to the Federal Reserve. We either go in September or we wait until December, but I wouldn't rule anything out.
Their biggest concern is if things go south, how fast do they go south and what do we really do?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Bramo got so bored of this market, she's taken the next 2 days off. 51.8770 at the close on Tuesday. On Wednesday, yesterday, 51.8767. This equity market going absolutely nowhere. Danny Berger's in the hot seat this morning. Good morning to you all. This is Bloomberg Surveillance. AMH is down in Washington, D.C., and we've got a lot to talk about, starting with central bank decisions. Some might say the global easing cycle is underway. First out the gate, the S&P, quickly following Sweden's Riksbank. Will the ECB and Bank of England make a move, Danny Berger, in the next couple of months?
So I see this. You brought the fake Brit onto the BOE day.
To join the real Brit.
To join the real Brit. Fair enough. I mean, I most recently lived in the UK. But this is the thing. The Swiss and the Swedish have already shown us there's a willingness to go, not even just before the Fed, but before the ECB. The concern, of course, is currency weakness. Deutsche Bank has gamed this out, saying, actually, the sterling will move less than it has in the past decade, that the rate sensitivity is just not as big as it used to be. Sterling right now, 124.87. That decision about 60 minutes away. If you want some drama, as we've been doing over the last couple of weeks, Danny, you go to dollar yen, 155.92. That currency pair positive by 0.25%. The yen has been weaker every single day this week in the face of increasing criticism coming from officials both at the Ministry of Finance and now the BOJ. Yeah, what a slap in the face. Not only has it been weaker, but we've consistently seen this market and hedge funds willing to go to 160, willing to put those option pairs on. It might be an issue of credibility, but John, one thing we forget is that the BOJ is not independent in the sense that we think about the Fed, we think about the ECB. It's part of the Japanese government. They were just speaking days ago, of course, Ueda and Kishida. And then we get this outcome. It's a very, very different central bank. We'll be talking about some of those moves later in the programme. Need to talk about these big moves in the equity market as well. If you've missed this week, come anywhere close to missing, you've been absolutely punished. I'm thinking about the close to 10% move we saw in the Walt Disney Company earlier on this week. Arm Holdings is down by about 8.5% in the pre-market. It doesn't take much in this equity market at the moment to trigger an outsized move in response to those earnings. The sentiment has shifted. There's no doubt. Usually when you see a move like that, you think, what a great opportunity to buy the dip. Something is different this time around. You see it in the flows. People have reduced their shorts, but they're not putting on new longs. Things are expensive out there, and perhaps with the uncertainty and the volatility of every economic data point, and earnings needs to be perfect to buy. Let's get to the broader price action for you and kick things off with this. We're pulling back by 0.25% on the S&P 500. Just a little bit softer here. 5 days with no real losses. Here's your pullback. Not much of one, is it? Yields are higher by a basis point or two. We're back in the 450s on a 10-year, 451 in the FX market. The euro just a touch weaker here. Euro dollar 107.31. Coming up this hour, we'll catch up with Russ Kostrick of BlackRock as equities snap a 4-day winning streak. Ed Mills of Raymond James as President Biden sends a warning to Israel. And Sarah House of Wells Fargo with investors looking ahead to CPI next week. We begin with our top story, the S&P 500 treading water after delivering its biggest 4-day advance this year. Russ Kostrick of BlackRock saying this: we remain overweight equities based primarily on our views surrounding strong earnings and cash flow generation. Estimates of nominal GDP keep rising, which should support earnings growth. Russ joins us now for more. Russ, let's get into the earnings story first, sir, and it's good to see you as always. If you missed this week, in fact, in this quarter, this reporting season, you get punished, and it doesn't take much of a miss. Russ, what do you make from that? What is the signal that you take away from it?
Well, good morning, Jonathan. I think the short answer is the market's moved a good deal off of the October lows from last year. We've got some crowded trades, and this is an earnings-driven market. You think about 2023. That was all about repricing. It was all about multiple expansion. And because of that, as you pointed out a moment ago, the market is not cheap. And this is a year where stocks are going to be driven much more by earnings, by cash flow, by profitability. If companies are not showing investors what they like, you're right, they're getting punished very quickly. JP Morgan, Marko Kolanovic with this to say: earnings expectations are too optimistic. Russ, you appear to take the other side of that. would take the other side of that, and there are a couple of reasons. First of all, I do think you've got a number of companies, we all know who they are, that are dominant in the indices that are tremendous at generating cash flow. They've got moats around their business. They are levered to long-term themes, whether that's artificial intelligence, internet commerce, and I think that continues to be a long-term trend. But the simpler answer for most of the companies is that ultimately the top line is going to be driven by nominal growth. And you think about what's happened. You go back to last year, there was still a lot of calls for a recession. And now we've got estimates for 2024 GDP at 2.4%. Inflation obviously is a little bit stickier than everyone would like. But you add that up, and you're likely to get a year where nominal growth, nominal GDP is 5% or north. That's a pretty good environment for earnings. What's expected right now is 244 for the S&P 500. That's around 10% growth. I think if you get 5% nominal GDP, that is a very attainable number.
Russ, I get that. And I get why stocks would do well in that environment. But here's the thing that confuses me is that small caps haven't been. Earnings growth is something like 0.3%. They're underperforming the market. If growth is lifting all tides, why not the small cap tide?
Well, that is a great question. And I think there are a couple of reasons for that. The first of which is this has become, I think, as we all know, very much, for a lot of industries, a winner-take-all economy. So the growth you're seeing, the earnings growth you're seeing from some of the large companies, from some of the Magnificent Seven, that is a multiple of what you're getting for smaller companies. The other reason the small caps have struggled, remember, they had a decent rally, actually a very good rally in November and December. Why was that? Well, back then, rates were heading lower. One of the things that has reasserted itself this year is this notion of rate beta. Parts of the market that are more sensitive to rates, and whether you're talking about small cap or early growth companies, they've had a much tougher year. And not that rates have skyrocketed, but we've seen nominal real rates up 50, 60 bips. That, I think, is having an impact on certain segments of the market, definitely small caps.
Russ, you also like credit, but Bank of America had a note out earlier in the week basically saying a record amount of high-yield bonds are trading like IG. Does that not worry you?
Well, I think there are concerns about where current spread levels are at, but I go back to a couple of things. One, a lot of the credit we have in the portfolio, we bought when spreads were much wider back in 21 and 22. We're not adding significantly to it. There are parts of the market that are interesting, but basically, we're clipping that coupon, which is creating for the first time in years a very nice tailwind in a multi-asset portfolio. But the other thing to note is, again, going back to that nominal growth argument, if we are in an environment where nominal GDP is going to be, again, let's call it 5% or north, where a lot of companies, both in IG and the high yield space, termed out their debt several years ago, I think that's an environment where we can expect that the default rate is going to stay low as it has been for a while now.
Russ, given what you expect nominal GDP to look like, does that keep you away, steer you away from duration in government bonds?
I think it depends on the part of the curve. Jonathan, as we've spoken about, we've been modestly underweight duration for a long time, and we're keeping that. Now, it's not everything. Again, as I said, we've got an overweight to credit. There are parts of the curve, whether it's the short or the belly, that we think look more reasonable. But yes, we have been more cautious on the long end of the curve. Several reasons for that. The stronger growth environment, the fact that inflation has remained sticky. And as we've spoken about, while it's more of a longer term issue, you've got to be a little bit cognizant of the amount of supply coming into the market, particularly when it comes to Treasury.
So, Russ, with that in mind, within the portfolio, where do you find risk mitigation at the moment? Because you're underweight duration at the long end, okay, one. Two, you're underweight defense. Top of the pile there seems to be staples, don't like those. What do you like on the defensive side of things?
Well, this is a great question. And I'd say one of the challenges now in a multi-asset portfolio is your hedges become more difficult. There were a lot of challenges last decade. But when your concern was always low growth rather than inflation, the hedge was fairly easy. You bought long duration, and that worked remarkably well for over a decade. And to your question, I think it's a tougher call now. So there is no one single asset I can give you. I'll give you a couple strategies. Generally, being long the dollar, at least against the euro, has worked in an environment where often when the market sells off, you're most concerned about the Fed. Using volatility as an asset class, using vol when option prices are cheap, that's another way to manage your downside risk. And the last idea I'll throw out is this notion of having high quality stocks as a self-hedge. Looking for, again, a lot of those companies with high profitability, with margins that are consistent, not that they can't go down, but on a relative basis, we think they hold up better than the broader market.
Russ, right now, though, is the moment where volatility is cheap. It is extremely cheap, decade lows by some accounts. People aren't buying it. People aren't looking for protection there. What gives?
It's a good question. I can't really answer that other than we have an environment where people are still looking for risk. And the other thing to note, which we haven't spoken about, is one of the factors that probably supports the market going higher beyond earnings and beyond rates is simply the fact that there's still a lot of cash on the sideline. And particularly as we get to a point later in the year where we do think the Fed will cut, albeit later than people thought and hoped, some of that money is likely to come back into the market. So I think part of the reason people may not be looking for protection as much as they might is there's still a lot of cash to be put to work.
T-bills and chill. Russ, let's finish on that. You mentioned a couple of rate cuts. Is that enough? Is that sufficient to unlock all that money parked in money market funds?
Well, I certainly think, 2 rate cuts is different than the 7 or the 6 that we expected back in the beginning of the year. But I think the market can live with an environment where growth is strong and maybe the Fed only cuts a couple times. And, one of the things that is helped this year, rates have moved up, but generally the move has been contained. Rate volatility has come down. So if we get a couple of cuts, yes, I think the short answer is the market can live if we just get 2 cuts this year.
Hey, Russ, good to hear from you, buddy. As always, Russ Kostrick there of BlackRock breaking down this market. We've been starved of data this week. It picks up a little bit at 8:30 Eastern time. We'll get jobless claims. The estimate 212, the previous number 208. Fast forward a week, Danny Berger, and then we can get real about real data. CPI retail sales the same day, May 15th.
You know why it's frightening for this market? Because earnings season is largely going to be over. We're not going to get a Fed decision for a while. So what happens with each data point where we don't know what the Fed is going to do? It is lots of volatility, which, oh, by the way, a market that's not very well hedged, to Russ's point, it can get scary on days like that.
Retail sales fascinates me. Just how is the consumer doing in America? If you take Starbucks, not great. You take the theme parks at the Walt Disney Company, tremendous. Where is the US consumer right now?
Well, clearly not drinking your lavender lattes. That has been made extremely clear. I don't know. It's the whole thing of the shift of, oh, they want experiences. Oh, they want this. But there is this degree to which the lower consumer, the lower class, the one who's going to McDonald's is the one who is not spending. It is this bifurcation of the American economy we continue to see.
Talked about that a few times. Mike Wilson, Morgan Stanley, upper end stability, lower end fragility. Equities right now, a little bit fragile relative to the stability we've had over the last week. We're negative here by 0.2% on the S&P. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Sonali Basak. Hey, Sonali.
Good morning, John. Shares of ARM falling in the pre-market. The chip design company gave a lackluster revenue forecast for the year, raising concerns that the tech industry's AI spending spree might be slowing. 3 months ago, an upbeat forecast sent ARM shares soaring and helped turn the company into an AI darling on Wall Street. The stock was up 41% this year through Wednesday's close. And living in Manhattan is getting even more expensive. Apartment rents rose to a new high for April. Leases were signed at a median of $4,250, up $9 from the same time a year ago, according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. Rents have climbed annually in 3 months of the past 4 months, suggesting another record-shattering summer to come. And MAGA has joined TikTok, the Political Action Committee, or PAC, becoming the first Trump-affiliated account on the Chinese-owned social media app. The Super PAC's first videos, posted under the handle MAGA, attack President Biden's economic record and label independent presidential candidate Robert F. Kennedy as a, quote, radical leftist. Trump and Biden, who have been on TikTok since February, have both supported a ban on the social media app over national security concerns. And that's your Bloomberg Brief, John.
Hey, Sonali, thank you. Much more from Sonali in about 30 minutes' time. $42.50 median rent in Manhattan. Just absolutely ridiculous. Up next on this program, Biden's warning to Israel.
I've made it clear to Bibi and the war cabinet, they're not going to get our support if, in fact, they go in these population centers.
It's quite a warning from the President of the United States. If they go into Rafah, I'm not supplying the weapons. That conversation up next. It is Thursday morning. Good morning to you and welcome to the program. Equity futures on the S&P 500 just a little bit softer, down here by 0.2%. Yields a touch higher, up by 2 basis points on a 10-year, back through 450, 451.21. Under surveillance this morning, Biden's warning to Israel.
they go into Rafah. I'm not supplying the weapons that have been used historically to deal with Rafah, to deal with the cities, to deal with that problem. We're going to continue to make sure Israel is secure in terms of Iron Dome and their ability to respond to attacks. But I've made it clear to Bibi and the War Cabinet, they're not going to get our support if, in fact, they go in these population centers.
So here's the latest this morning. The president delivering his most public criticism to date about Israeli military actions in Gaza. Biden warning the delivery of additional weapons may be delayed if Israel continues a ground invasion of Rafah. Israel's Prime Minister Benjamin Netanyahu has yet to respond. Let's head down to Washington, D.C., where Annmarie is joined by Ed Mills of Raymond James. Morning, Annmarie.
Good morning, John. That was the strongest warning yet we've heard from this administration regarding the military weapons that they have been supplying Israel. Ed, what do you make of that? Because yesterday we talked about this in the context of this is just a pause. Now this sounds definitive.
So the thing I make of this is that there is an election in November, and that President Biden is looking at the polling data and shows that geopolitical risk, any rising tension, is a significant headwind to his reelection. And if you have Israel expand the war after he signs into law a kind of defense supplemental and is transferring the weapons to Israel, he owns this much more. And politically, that's impossible for him to withstand. And so this is a closest to a red line as we are going to get from the Biden administration.
How does he do both, though? He also said in that interview, she talked about the Iron Dome. He continuously says his support for Israel's ironclad. And in the same breath, he'll also say something like, quote, we're not going to supply the weapons and artillery shells.
So, Annmarie, I think most of life is what I call a both and. It's both strong support for Israel and conditions, especially when it is U.S. taxpayer dollars coming here. I think what was also really important in that interview is that he was discussing after there is a ceasefire, how does Gaza get rebuilt? Different Arab neighbors of Israel. One of the things that we've heard a lot from our contacts here in D.C., and we've talked to Raymond James clients about this, is that I think the Biden administration is also looking at Saudi Arabia as a potential longer-term solution. Can they normalize relations with Israel in exchange for Israel recognizing a Palestinian state? And so that's also a both and. They're dealing with the immediate conflict, but are also looking at what comes next, what's the rebuilding, what could be the legacy of this administration.
We know the direction of travel the Biden administration wants this story to go. The issue is, how do you get there? Because if they're saying they're not going to provide the military weapons that, say, Israel says they would need to eradicate Hamas, how do they get from point A to point B?
I think it's a very thin kind of line that you have to walk. I do think that immediately, I think the concern is the humanitarian issues within Gaza in an attack on Rafah. I think this is an administration that has been desperately wanting a ceasefire. There's obviously clear concerns within Israel about any continued control of Gaza by Hamas, who launched the terrorist attacks on October 7th. So it is trying to kind of work all diplomatic angles, trying to de-escalate the near-term situation to put together a long-term solution that actually works.
How much of this is about what is going on at college campus and the protests and the Gen Z, the youth vote that Biden needs to secure for November?
So, Annmarie, that's exactly what I talked about at the beginning here, which is we've seen in polling data that the Biden administration or Biden himself was doing quite well after his March State of the Union address. But with the increase in geopolitical risk, with the college campuses demonstrating, you've seen a rebound for former President Trump in a lot of polls, especially in swing states and especially among younger voters. The cratering among younger voters for President Biden is an alarm bell for his campaign. And so he cannot see an expansion and having a humanitarian crisis that expands within Gaza and probably win those voters over and win in November.
Also an alarm bell is the economy. Quinnipiac polling came out yesterday, just looking at Wisconsin, where Biden sat down and gave this interview. And they continuously give Trump higher remarks for the economy, and they rate the economy as the #1 issue. Now, I want to talk about taxes going into next year, because yesterday we heard from the CBO, if those Trump-era tax cuts come back and are extended, it's going to be $4.6 trillion added to the deficit.
Yeah.
How is this sustainable? Because this is what the Trump campaign is campaigning on.
So I think what was remarkable about that $4.6 trillion estimate The last estimate from CBO was only $1.1 trillion. So this is ballooned. We also heard yesterday from the chairman of the House Ways and Means Committee, a Republican on the tax writing committee, that he's talking to his colleagues. And a number of Republicans, Annmarie, are saying the corporate tax rate might have to go up. And so the market has expected that if there were to be a Trump victory, Republican sweep, that all of this gets extended out. But at $5 trillion, it's becoming less and less likely. January 1st of next year, we have the restart of the debt limit. So will the bond market allow Congress to lift the debt limit and then maybe cut taxes by another $4.6 trillion over 10 years? I'm getting increasingly skeptical. And for Democrats, if they're in charge, if they do nothing, taxes go back to where they were under Barack Obama. And on state and local taxes, that $10,000 cap goes away. And so a lot of clients that I talk to are like, well, $1 trillion tax cuts for New York, New Jersey, California, Massachusetts, Wisconsin. There are a lot of Democrats in this town that says doing nothing and not spending that additional $4.6 trillion might be the preferred path, especially if Democrats win.
If Republicans are voicing concerns about the corporate tax rate and they want to potentially come in line with the Democrats and raise it, what can you see in terms of the extension of these tax cuts? What's the base case?
So I think the base case is most things get extended under Republicans. Most things go back to what they were under President Obama, under Democrats. There are a couple things that need to be dealt with. First and foremost, the pass-through for small businesses. There will be a huge differential if we don't do anything there. Probably raising the standard deduction so that most people don't have to itemize. Something on rates, especially for lower end kind of income households. They could do a short-term extension. We talk about these in 10-year numbers, and that's $4.6 trillion. Nothing stops them from doing 1 or 2 years, because when Congress has an option, they like to take the least difficult option. So especially if there's not a majority kind of across the board for Democrats or Republicans, doing something 1 or 2 years is going to cost a whole lot less, and they can get that done.
Finally, Ed, if you're seeing already cracks within the Republican Party and people talking about, well, actually, even if Trump gets elected, even if we get a sweep, we might want to actually raise the corporate tax rate. What party, when you're at Wall Street and you're looking down to Washington, what party is more favorable for big business?
Well, Annmarie, it really depends upon what part of business that is. And, we even were having conversations with a lot of Raymond James clients about kind of defense stocks in the defense supplemental. And normally you would say Democrats are kind of skeptical, Republicans are good for defense spending, but it was the reverse in the defense supplemental. We look at China and tech restrictions. Trump could come in and ramp that up, and that would be much less predictable. On taxes, historically, Republicans have been more favorable, and they are more likely to extend some of this out. But it is not a one party good, one party bad anymore. It's a lot more nuance, which gives me a much more interesting job.
Ed Mills, Raymond James, Washington policy analyst. Thank you so much for joining me this morning in Washington. John, big fights ahead in 2025, especially those tax cuts, especially when you come to Washington, you hear Republicans are talking about their concerns and that they actually potentially want to raise the corporate tax rate, which is what Democrats want to do.
MH, a busy 6 months ahead for you down in Washington, D.C. Much more from Annmarie a little bit later. So much has been said about the situation abroad and what it means for the president's re-election chances come November right here at home, particularly in places like Michigan. Go through the polling. Bloomberg News Morning Consult. Think about Michigan just for a moment, OK? He's down 7 in Arizona. He's down 6 in Georgia. He's down 10 in North Carolina. He's down 4 in Wisconsin. He is up against the former President Donald Trump by 2 in Michigan. It's not about foreign policy. It's about the economy.
It surely is. And he has the advantage of Trump being tied up in New York, so he can go and make these trips while Trump can't. But is it the right message? Is it the right message to tell people, no, you are doing better than you think you are?
Much more on the economy with the former World Bank President David Malpass sitting down with AMH in Washington in the next couple of hours. Don't miss that. Don't miss this. Sarah House of Wells Fargo looking for a softer CPI print next week. The look ahead up next. Equity futures here negative by 0.2% on the S&P 500. Just a little bit of a pullback on the S&P 500 following yesterday's day of basically unchanged price action, going absolutely nowhere. On the Nasdaq 100, we're down 0.2%. The Russell's had a decent run. We snapped that. We're down another 1/3% on the Russell 2000. If you switch at the board and get to the bond market, yields lower for 5 consecutive days into Wednesday, then yields a little bit higher and back through 450 this morning, up a single basis point at 450.42 on a 2-year, just about unchanged at 484.27. Plenty to talk about in foreign exchange. Before we get there, just a couple of notes for you. Later on today, we'll hear from the San Francisco president, Mary Daly. Look out for that. 8:30 Eastern, jobless claims. Look out for this. Dollar yen. 155.91. We're looking at 156 all over again. Danny Berger, they got a problem over in Japan.
They do have a problem, and it is made abundantly clear by the fact that Ueda and Kishida spoke to each other. It's a problem for people who want to go abroad in Japan, maybe not for people who want to travel to Japan and spend money there, but it's also a problem for importing. It is a government problem, therefore it is a BOJ problem.
How many people are going to Tokyo that you know? That's all I hear about.
Yes, so many. I'm ready to go. I'm ready. It's cherry blossom season, John. I'm ready to go.
What do they call that? Momiji-gari, I think, is leaf peeking. Over
you
in
know more than me.
Something like that.
All I know is there's a great view of the Shibuya crossing at the Starbucks. That's all I got for you.
Okay, we'll try and figure this out. Let's look at sterling just briefly. We are about 29 minutes away from that Bank of England decision. 124.96 on cable, totally unchanged. Look out for the vote. The evolution of the vote. Danny, I think that's what we're looking for, right? Basically, you had a couple of officials 2 meetings ago still calling for hikes. They've dropped that call. You had one official still calling for a cut. We're trying to work out whether that official gets some company in about 30 minutes' time.
Yeah, it would likely be David Ramsden, because he came out and basically said, I'm less concerned about inflation. You compare that, though, to Hugh Pill, who says, I have the same view I did in March. And that view, of course, was that rates still needed to be higher than longer. So regardless, we know it is a split MPC, but that matters more, of course, than what Andrew Bailey says, much to his chagrin. We care more about those individual members than the man himself.
Looking for the breakdown of the votes in about 28 minutes. The Bank of England decision just around the corner. Here are some of the top stories for you. Under surveillance this morning, President Biden sending a warning to Israel. Biden telling CNN he will delay more weapons if Israel continues with a ground invasion of Rafah. The comments coming after the US already paused the shipment of about 3,500 bombs. The warning was pretty clear. I think the president's very clear-eyed about what could take place here. If they go into Rafah, I'm not supplying the weapons.
And went on to say that, yes, these weapons have been used previously to kill civilians. One of the interesting things about this, the Wall Street Journal reported that originally Biden had hoped that this would be under wraps, that he would negotiate with the Israelis and the public wouldn't know about it. Biden is someone who's given very few media interviews recently, something that he's been very criticized about. So the fact that not only is he not doing these negotiations behind closed doors, but he's using one of his few interviews to talk about it and send a message.
We mentioned this yesterday. Think about what's on the table. 3,500 bombs, which could be used to target one of the most densely populated areas on the planet. We're talking about Rafah with more than 1 million Palestinians. Can you imagine the devastation and damage that could be done there and the headlines back home going into November?
Biden can't have that. He can't have that. He's already had the youth vote turn against him. You already see what's happening across college campuses. Whether you think it's right or it's wrong, the impact is one that the Republicans can say, look at the lawlessness, look at the commotion that Biden has basically made come to the fore. One of the ways he gets that settled is by something that creates a ceasefire, and weapons, that is the tool, right? That is the tool that America can use.
And that's the latest on the Israel-Hamas war. Here's the latest in Japan. We mentioned it briefly. The BOJ Governor Ueda using tougher language on the yen after a meeting with Prime Minister Kishida. Ueda telling the PM he's carefully watching the impact of a weak yen on prices, then speaking at an event saying abrupt and one-sided weak yen moves raise uncertainties and are negative for Japan's economy. There was a quote, Danny, from Kit Jukes in the last 24 hours, and Kit, as always, over at SocGen, absolutely nailed it. Yellen's observation that FX intervention should be rare and accompanied by consultation will embolden yen bears. And I took away the same signal over the weekend.
And also just the idea of they continuously say, look, when it deviates from fundamentals, that's when we're concerned, the one-sided bet. Well, if you're a yen bear, you'd say this is fundamental. The bond market is volatile. We're going in and we're going to push this and see if we can get it to 160. But the thing is that this is a change of language in only 2 weeks. And this gets to the point of credibility. If he's changing his tune so quickly, if you're a yen bear, you'd say, why would I believe you this time around?
This started to brew, I think, at the IMF World Bank meetings a couple of weeks ago. You could hear the complaints, not a big response from the President. No response so far, but getting more of a response from the Treasury Secretary, Janet Yellen. Fed President Susan Collins adding to the higher for longer narrative. Collins saying, quote, "The recent data leads me to believe this will take more time than previously thought." Investors looking ahead to CPI next week. Sarah House of Wells Fargo saying this, excluding food and energy, we estimate prices rose 0.3%, which would break the streak of 0.4% gains since January and push the year-over-year rate down to 3.6%, a 3-year low. Sarah joins us around the table for more. Sarah, good morning to you.
Good morning.
Is 0.3 good? Is that a good thing?
It's certainly better than what we saw the past 3 months, where we had that string of 0.4 readings, which surprised to the upside. So I think it's at least a step in the right direction of resuming the journey back towards the Fed's inflation target. But at the end of the day, I think that's still a bit strong, but it's at least improvement from what we saw in the first quarter.
Does it open the door to a conversation about July? Or has it not come soon enough?
I don't think it's strong, and I don't think a 0.3 print would be enough for July, just when you think about the data calendar. And I think really you probably need to see, at least on the CPI front, probably set core numbers closer to 0.25s, I think, to keep even a September rate cut in play. So April is going to be the first step to, I think, keeping the door open to even a September cut at this point. July is going to be pretty tough unless you see a market weakening in the labor market.
We had Kathy Jones at Charles Schwab in your seat yesterday, and she alluded to the fact that maybe Q1, for her at least, the strength might have been a bit of a head fake. Would you go with that?
I think there's the potential for some residual seasonality there, where you just saw such strong pricing at various different points in the year that the seasonals are maybe not fully accounting for the typical early year strength, but they still do anticipate more strength in the early part. And so I think there's still some signal in the firmer readings. And I think it's also possible that it's catching up for the second half of last year, which was a bit of a head fake in itself. So kind of smoothing that out, we're still looking at overall core inflation still probably going to be 3.6, even with some downshift in April.
It feels like every piece of data is a head fake. Every piece of data we have to evaluate, is this really the trend or is it not the trend? That's obviously not how the economy works, though. There is some sort of trend, though. So with each piece of data coming in, can you get a clear read at this point? Can you have conviction in your calls right now?
So I think the second quarter numbers are going to be very important, since Q1 was so messy, whether we're talking inflation, whether it was talking maybe payrolls, even ECI. And so Q2 is going to be really important for how much of that was noise or signal. But it does make it difficult to, I think, really have a lot of conviction in terms of what's not necessarily the direction, but at least what's the magnitude, what's the pace of whether it's inflation, whether it's job growth, whether it's the overall economy.
Well, if the magnitude and the pace is a slow one, going in the right direction, but perhaps not picking up or going as fast as the Fed would hope, is that enough to say that policy isn't tight enough?
So I think when we step back and think about how restrictive is policy, it's in part the inflation data, but I'm also looking at the growth data to tell me that. Inflation is a lagging indicator, but I think what makes me question the degree of restrictiveness is really the strong activity data that we continue to see coming in, at least the underlying components of GDP, some of the consumer spending numbers. That leads me to question it a little bit more than inflation. I think if you do see a downshift in activity, that's also going to help inflation, along with, I think, some still long tails of some of the supply dislocations that we've seen over the past couple of years.
There has, though, been some anecdotal evidence, perhaps, of weakening growth, of weakening consumer, be it everybody flocking to buy now, pay later, be it Starbucks, McDonald's, surveys. How much do you pay attention to those sorts of pieces?
Yeah, I think they're really important at this juncture, where we're looking for any pieces of data, especially given timely reports like that. I think anything that helps us parse out what's happening across different segments of consumers is really helpful. So we know higher income households are doing better. They haven't been as impacted by rates when we think about what their mortgage payments are, things like that. And so that's really helpful in terms of, are we starting to see some pushback in terms of that pricing? Because there's not a lot of great indicators that check the degree of pushback. We can get things like the NFIB pricing plans, but that doesn't really get at, well, we're having trouble actually passing on those prices, and we're going to hold back a little bit more.
Here's a read on things. So you mentioned buy now, pay later. Fantastic story from our colleagues at Bloomberg News overnight, with a Harris poll that found 43% of those who own money to BNPL services said they were behind on payments. 28% said they were delinquent on other debt because of spending on the platforms. Can you help me understand if we're getting an accurate read on what's happening with the US consumer at the moment because of maybe some of these places that aren't gauging things?
Yeah, so I think that is one of the pieces that it's been harder to get an eye on. So my colleagues, Tim Quinlan and Shannon Grain, have talked about this is the phantom debt component, but I think we're seeing still that stress in the consumer that I think is also indicative of what we're seeing in the buy now, pay later, just in terms of the credit card delinquencies, as much as they've risen back to the highest rates since 2008, what we're seeing in terms of the credit card rates, these things are correlated. And so I think even as we don't have a great line of sight on that, you are still seeing that stress in certain segments of consumers.
This speaks to what Danny's talking about, which is whether we are sufficiently restrictive or not. Plus, where we end up. Where is neutral? And why is this Federal Reserve not engaging in that conversation in quite the same way the market participants appear to be?
Yeah, so I think at the end of the day, we don't know exactly where neutral is. It's unobservable. We only know it in hindsight. And I think given the uncertainty around it, that's made it difficult for Fed officials to really engage with it. But we are starting to see that more. You saw Kashkari earlier this week talking about he's thinking neutral might be higher, and that's why financial conditions might not be as tight as he would have expected. And we're starting to see it in the dots too. You've seen that the median drift up, but even more so the average. And so I think there is a lot more thinking about that, even if it's not front and center.
Well, this gets to the Mohamed El-Arian argument, which is basically you can't get back down to 2%. Not that you can't, but you shouldn't, because in order to do it, you cause unnecessary damage to the economy. Is that right? To actually get back to 2%, it would be extremely ugly in this American economy.
Well, we've seen, I think, obviously a lot of supply help in this on this front, but I think we are in a harder part of the cycle where if we look at labor force growth, that's grown close to 2% each year of the past 2 years, but now you have things like prime age participation, close to the highest it's been in 20 years, signs of leveling out, and so I think it's going to get harder to see those additional supply side gains. We've seen supply chains returning to a more neutral level, so I think this next phase of the inflation fight, it is going to require more pain and I think a bigger hit to demand than what we've seen over the past year or two.
You've been talking about that for a while, the last mile, the hardest one. Sarah, thank you. It's good to see you, as always. Sarah House there of Wells Fargo. Looking ahead to some data next week, CPI on May 15th alongside retail sales a little bit later this morning, 8:30 Eastern Time. Jobless claims, the estimate in our survey, 212, the previous week, 208. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. The bundle is back. Disney and Warner Brothers Discovery announcing that they will sell their biggest streaming services together starting this summer. Subscribers will have access to Disney Plus, Hulu, and Max, both the ad-free and ad-supported versions. The companies have not given a price for the combined service, but similar offers typically come at a discount to individual subscriptions. And Elon Musk is closing in on a major funding round for his AI startup. xAI is set to be valued at about $18 billion when the round closes as early as this week. And that's nearly triple what had been estimated, with Silicon Valley firm Sequoia Capital contributing to the valuation. A source saying that the platform will be able to train from data on X to help build its language models. And ultimately, it aims to compete with OpenAI. xAI currently operates the chatbot Grok, available on X. And Real Madrid will meet Borussia Dortmund in next month's Champions League final in London. Two late goals from Madrid sealed a 2-1 win over Bayern Munich to advance to the final, where they'll look to win their fifth Champions League title in the past 9 years. Earlier, Dortmund beat PSG to advance to their first final since 2013. And that's your Bloomberg Brief, John.
Shonali, thank you. Just leave the picture of that man right there up. Carlo Ancelotti, the manager of Real Madrid, 4-time winner as a coach, twice as a player over at AC Milan back in the days. Absolute legend. What a finish it was going towards the end of that game just yesterday. That's enough of that. Up next on the programme, traders looking for doves at the BOE.
I don't think in the UK we have felt the maximum impact of past monetary policy tightening. So I think there is a clear possibility that BOV could actually deliver more easing that the market is currently pricing.
The conversation up next, that rate decision, about 15 minutes away. Live from New York City, equity futures right now pulling back just a touch. We're down by 0.2%. Yields a little bit higher by a single basis point, 450.42. On the euro, 107.35, negative by 0.1%. Under surveillance this morning, traders looking for doves at the BOE.
conviction is quite low, not just in the FX market, but I think also in the rates market based on what's priced in. I don't think in the UK we have felt the maximum impact of past monetary policy tightening. So I think there is a clear possibility that BOV could actually deliver more easing that the market is currently pricing.
So here's the latest this morning. The Bank of England rate decision due at the top of the hour. Jeremy Stretch of CIBC writing, quote, "We would be unsurprised should the bank look to prepare the ground for a June adjustment. We expect a 25 basis point cut at the next meeting and assume 75 basis points of easing in total this year." Jeremy joins us now for more. So Jeremy, let's get into that. We've heard from the S&B cut.
Good morning, John.
We've heard from the Riksbank cut. Are we going to see the same thing from the BOE and the ECB later this summer?
Yes, I think that's highly probable. I think we would expect both of those central banks to be very much biased towards monetary policy easing over the course of the summer. So we're looking for both the ECB and the Bank of England to start their policy adjustments in June. The Bank of England, well, clearly the inflationary dynamics have yet to come into place in terms of reaching the target. But when we get the next CPI release, I think it will be pretty close to that 2% target threshold. But I think the important point today is not only the vote composition, because watch out for Mr. Ramsden's vote, but it's also going to be the inflation profile that the bank produces. Now, we know the bank have had a little bit of pressure on their forecasting strategy and methodology from the Bernanke review. But nevertheless, I think we will focus on that inflation profile. And if that's revised down, then I think that will open or prepare the ground for a policy easing at the June meeting.
Let's breathe some life into that. The inflation profile, how different is it in the United Kingdom compared to what we experience here in America?
Well, I think there are certainly some similarities. Clearly, the UK continues to witness significant degrees of service sector inflation. So that, I think, is one of the factors that we are continuing to monitor. And of course, the labour market is also continuing to generate or register reasonably elevated degrees of wage growth. But I think we are starting to see some signs that discretionary spending is still under some degree of pressure. We will expect that to be further compromised as we see mortgage resets continue to work through the system. So I think we can and should see some degree of moderation in terms of activity. And of course, I think the Eurozone and the UK are probably in similar circumstances regarding the macro and or inflation profiles. And perhaps that's the delineation with Europe relative to the US. The macro story is much weaker than we're currently seeing in the US. And that's the reason why the Fed is going to be somewhat more reticent to adjust policy, although even there we still expect the Fed to be starting to cut rates by September.
Well, of course, Jeremy, no central bank wants to go at it alone. Of course, they will if the data says that they need to. But is the ECB going in June? Is that a huge opening right now for the BOE just there in front of them to tailgate off the back of their cut?
Well, I think there is certainly some communication that will obviously be ongoing between the various central banks. We've seen already a couple of central banks ignoring or moving well ahead of the Fed in terms of the Riksbank this week and, of course, the SNB. I think in the context of the Bank of England, they will look to adjust policy without reference to what the Fed is doing. Clearly, there will be some policy implications in relation to the valuation of sterling relative to the dollar. So it may well be the case that we do see a slightly cheaper value of sterling as a consequence of that earlier policy adjustment if we're right in June. But I think the bank will be very much focusing on the domestic data, and that is going to be the important factor here. So I think in the context of today, the Bank of England governor will no doubt try and maintain maximum optionality in terms of the policy outcome, but ultimately the data, I think, will, allied to the forecast profile, warrant policy easing as at the next meeting in June.
Well, Jeremy, let me bring another American corollary in, because many folks have said, okay, the Fed, they can't move when it comes to November because of the election. In the UK, we're expecting an election. Rishi Sunak has said it would happen in the second half of this year. It needs to happen by at least January of 2025. Does that impact the BOE's timing?
No, I don't think it does. I mean, clearly, monetary policy doesn't operate in a vacuum, but in the context of the Bank of England, they are very much judged by their economic thresholds and, of course, that inflation profile. So I think, yes, there will be some external influences on the bank's thinking, particularly if there were to be another fiscal event being announced by the government before the calling of the election. Now, it doesn't look as though the public finances will warrant that, but certainly there had been previously speculation there could have been another fiscal easing in an early autumn budget. But I don't think the political timetable in itself is going to cause a significant degree of consternation from the Bank of England. They will be looking purely at their macro dynamics, and then that will warrant whether the timing is appropriate as early as June for policy easing.
I think a lot of people would agree with you, Jeremy, and that would apply to the Federal Reserve as well, which is why so many people are looking to September. We saw that from Sarah House of Wells Fargo. September, first cut from the Federal Reserve. Where it changes, the wrinkle I think it introduces, Jeremy, is 2025. I really struggle to find any clear outlook whatsoever on 2025 without knowing or understanding the outcome of November.
Yes, that's absolutely true, because clearly if we were to have Mr. Trump back in the White House, the risk is that if we were to see a reacceleration in trade frictions and the associated price pressures that would bring, then that would clearly have an important dynamic or underline an important dynamic regarding Fed thinking. So in a sense, that is the difficulty that we all face as market participants in terms of trying to anticipate the policy outlook for the Fed in terms of 2025, because we have to make judgments or at least assessments as terms of the underlying inflationary dynamics. But ultimately, as it stands, we are still expecting a graduated easing in policy through the course of 2025. We should see yield curve steepen as we do see the Fed reacting to a slower growth trajectory and or a moderation in inflationary pressures by some toleration of easier policy. So we're expecting, obviously, as they say, two cuts this year from the Fed starting in September. Yeah. But obviously, the outlook for 25 is going to be contingent on the political outcomes.
Do you think the Federal Reserve dictates how far the others can go? And I'm thinking more specifically of the European Central Bank. If they don't go for a long time, does that dictate and shape how far the ECB can go beyond, say, a June cut?
Well, I think June is effectively a given, and certainly that's the way the market is priced. I think if the Fed were to be on hold for longer, now, as I say, that's not our base case view, but if the Fed were to be on hold for longer, then there would be a risk that if the ECB were to be seen to be much more activist, and the Bank of England would be in the same boat, perhaps, then that would potentially have some implications via the currency transmission channel in terms of inflationary dynamics. So there is an element of sort of constriction in terms of how far both the ECB and the Bank of England can move ahead and beyond the Fed dynamic. As I say, we're assuming 50 basis points of easing from the Fed this year, and that is not inconsistent with expecting a little bit more from the ECB and the Bank of England, where we expect 75 basis points of easing from both.
Jeremy, what sort of difference in timing would it take for us to start talking about euro parity again?
I think if we were starting to see the Fed very much off the agenda through the context of the rest of this year, so I think that would be certainly something that would be necessary, I think, and we probably need to see the ECB announcing a rate cut in June, but also leaving open, if not a pre-commitment, but certainly a clear bias towards significant policy easing in the second half of the year if the inflationary dynamics are proving to be well behaved. So I think that's the sort of narrative. We would need to see a significant degree of sort of divergence in terms of rate expectations vis-a-vis where we're currently priced in order to facilitate certainly a move down through that 105, 103 area. And of course, once you were to get down to those sort of levels, then parity thresholds would start to come back into vogue, or at least into discussion.
107.35. Jeremy, thank you, sir. Jeremy Stretch there of CIBC on the euro just at the end. I want to bring up David Malpass, the former World Bank president, who wrote this in a Wall Street Journal recently. He'll be speaking to Annmarie in about 35 minutes' time. January 1st, the suspension of the debt limit expires. This year's spending bills will likely be extended just long enough to kick the can to 25. Tax rates will rise at the end of 25 unless Congress and the president can agree to extend some of the expiring provisions. 2025 is so difficult to get your hands around. If the former president gets a second term, you're staring down the barrel of massive tariffs too.
Yes, and it's not just that. Something many people have talked about, this idea that it also stymies the flows of immigrants. Immigration has been such a big topic, and why the economy looks as strong as it does, why the labor market is healthy, and why inflation is low. What happens when that's not the case anymore?
That conversation just around the corner. Here's the lineup for you in the next hour of Bloomberg Surveillance. We'll catch up with Sri Koshagoverdan of Aberdeen. We'll speak to Eric Friedman of US Bank Asset Management, the former World Bank president David Malpass sitting down with Annmarie down in Washington, D.C. And we'll catch up with Bloomberg's Javier Blas on the commodity market. This time, apparently, it's coffee going crazy. A Bank of England decision is just about 4 minutes away. The equity market stateside on the S&P 500 negative by 0.2%. The second hour of Bloomberg Surveillance up next.
U.S. exceptionalism, it's making its way through the U.S. stock market, and I think that can be somewhat sustainable.
There's been some wild swing at the stock and the sector level. Dispersion of stocks have been high in terms of performance.
We would like broadening out in the rally, but it is really not happening to the extent that we would like.
We're looking for a broadening effect. We have been for some time now.
We are cautious on both equities and on fixed income, and we're really waiting for better opportunities to add to both of those asset classes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now. An absolute stacked lineup for you. Coming up on the program, Sri Kotchagovindan of Aberdeen on the Bank of England rate decision. Former World Bank President David Malpass on the, quote, perfect storm facing the next US president. And Bloomberg's Javier Blas on what's behind the surge in commodity prices. The Bank of England leaving rates unchanged as expected. Danny Berger at 5.25.
And the split is important. We now have 2 MPC members who have voted for a cut. This is what we expected, that David Ramsden would join Swati Dhingra. This is the part that is important here because it shows an MPC where more movement is going towards a cut. You also have inflation. They see it at 1.9% in the second quarter of 2026. We've been pricing the BOE a lot like the Fed. We've been pricing a BOE who moves after July, who perhaps moves in August. Perhaps we need to rethink that now.
The guidance from the Bank of England, risks from inflation, persistence are receding. From Governor Bailey, optimistic things are moving in the right direction. Guess where sterling is? Sterling off the back of this, weaker. The pound down to about 124.58, a negative a third of 1%. Out of the UK, in London, Bloomberg's Lizzie Burden breaking this decision down. Morning, Lizzie.
Good morning, John. Yeah, it's a dovish hold, this one. As expected, holding at 5.25%. Only 1% in markets saw a chance of a cut today. But as I say, the signal's dovish. Look at that vote split, 7-2. Dave Ramsden joining Swati Dhingra. He had made a speech that suggested he'd had a dovish tilt. And so there was speculation that he would join. If you look back through history, in November 2021, he voted to hike before the majority followed in December, and then in both February and September 2022 he voted for larger hikes, and then the rest subsequently followed. So the market will take this as a dovish signal. Perhaps you've seen the response in sterling there. It would be interesting at the press conference to hear if Andrew Bailey gives more of a signal like Christine Lagarde did about which data points they're watching for as to when to cut. Will that suggest that they go for June over August?
So if you are just tuning in, a rate decision 5.25, the Bank of England leaving rates unchanged, in line with estimates. The focus was always on the vote split over the Bank of England on the MPC. Out of the 9, 7 voted to keep rates on hold, 2 voted for a cut. That's an extra voice looking for a cut of 25 basis points. The guidance from the Bank of England, risks from inflation persistence are receding. Lizzie mentioned the Governor of the Bank of England, Mr. Bailey. Governor Bailey saying optimistic things are moving in the right direction. Lizzie, just to follow up, what needs to happen between now and next month to make that cut a reality? What's on the calendar?
Well, there are various bits of data that they're watching for. What would be so embarrassing, really, is if inflation gets to 2% and the Bank of England hasn't cut by August. You've got to remember that it's easier to explain these things when there's a press conference, and there's one today and there's one in August, but there isn't one in June. But so if they wait till August, there's going to be a lot of pressure, but it's going to be harder to get the comms right.
Lizzie, what sort of Bailey are we going to see today? We obviously heard from Hugh Pill, who is more in the latter camp of rates need to seem restricted. What have we heard from Bailey so far?
Well, he has also made the dovish signals. Finally, he's acknowledged that the Bank of England's situation is a bit more like the ECB's than the Federal Reserve's in terms of the inflation story. It took a long time for that acknowledgement to come, but it's this dovish signal in that you could read into it that the cuts are going to come sooner because inflation is coming down in a different path to the US here in the UK. I doubt that he's going to give us any sort of clarity on the scale of the Riksbank yesterday. I don't think he's going to be telling us, Danny, that 1 or 2 or X number of cuts are coming in 2024 from the BOE.
Hey, Lizzie, great to catch up. Lizzie Burden out of London. The Bank of England on the margin, dovish, sterling weaker, bit at the front end of the curve in gilts. Yields lower by 5 basis points on a UK 2-year. That yield right now is 4.24. Joining us on this decision, Sri Kochagovardhan of Aberdeen. Sri, let's get into this one and how it follows up the Riksbank, which Lizzie mentioned, over in Sweden, the S&B over in Switzerland. Is the Bank of England about to join them and cut interest rates next month?
I think there is a good chance now, given what we've seen in terms of the vote split, as you mentioned, but also I think the forecasts have been quite interesting. That downward revision across the inflation outlook is quite key. And also, if you look at the undershoot from target, which I'm just looking at the summary now, I think that could be quite interesting, which is why we're seeing the price action now. So I think that there was a split between would it be June, would it be August? And I think now June becomes a bit more likely, obviously looking towards that press conference and the direction from there. I don't think they ever wanted to rule out June, but obviously it will be conditional upon data from here.
Well, let's get to the data and the outlook. So they see inflation at 1.9% in 2Q26, 1.6% in 2027. Sri, could you give me a better idea of what's driving that? Is that the demand side of the economy or the supply side?
I think it could be a combination of both. If we think more near term, there's very little adjustment there. And we are expecting a temporary dip below target over the next few months. And that's partly base effects from energy prices. Now, I think going forward, we're likely to see some of these pandemic-driven impacts on inflation. That's already starting to subside, but they're also looking more critically at that core underlying inflation and specifically at wage dynamics and the labour market. So I think the key drivers are likely to be focused around that labour market dynamic. And that's really something that they've been talking about materially over recent months.
Sri, the split of the vote, also important. It's something that I always find fascinating because it is a Fed who is so cohesive in their message, and it is a BOE which is anything but. You have Ramsden now voting to cut now. We know Hugh Pill has talked about Table Mountains, choose whatever analogy you want, doesn't want to move. Bailey, more biased towards the cut. What does it mean to have such a divided MPC when we are nearing the start of a cutting cycle?
I think the vote split is an interesting messaging tool. And I think, if anything, it's less divided than before. Remember, there was a 3-way split in the past. So this is clearly having a more dovish tilt. But obviously, we've heard more hawkish messaging from the likes, as you say, from Hugh Pill, from Haskell and Mann as well. But again, it's very conditional upon the data. And I think this overall split, and let's see what the forward guidance is from the press conference, but it does look like, we are past the worst in terms of that inflation dynamic. We are starting to see labour market conditions cooling a bit. And then really it's going to be that focus on wages, which is unfortunately above target consistent levels. But as we can see from the projections, they are signalling confidence that they can see wages cooling over time. Now, it could be the case that from the messaging that we see that the Bank of England doesn't actually have to wait for inflation to really prove that wages are cooling, that they can actually start the easing cycle. But remember, the messaging is also, even if they start cutting, rates will remain elevated for a meaningful period of time. So this is not going to be jumping into easy monetary policy. It's still very tight conditions and well above neutral rates.
Even so, Sri, Bailey has to get up there in front of the crowd at the press conference, speak to the markets just as much as he speaks to the journalists, and say perhaps some version of what you just said. But this is currently a BOE where it is the individual members who set the pace, who get the market reaction. It is not Bailey that is acting as the weatherman. Is this a credibility issue?
I don't believe it is a credibility issue. I think this is a technique that is very exclusive to the Bank of England. But it's also a very useful transparency technique as well. And I think this, the fact that there is, as I said, one direction, the split is starting to move more dovish. It's still the majority on hold. And you are correct. We need to look at not just what the governor says today, but also the individual speeches that will come after. Now that we're out of the blackout period, we'll start to hear more from those individual members. And I think what we really need to focus on is, as you say, the commentary from those more hawkish members. And I think the looking at the gilt price action now with yields falling, it's even though it's a 7-2 split, it does look like the markets have really interpreted this as a clear dovish signal.
That news conference starts in about 20 minutes' time. Looking across Europe right now, we've had a cut in the last 24 hours from the Swedish, the Riksbank. We've had a cut in the last few weeks from the Swiss National Bank, and now anticipating more, perhaps from the Bank of England as soon as next month, and maybe even the ECB as well. Sri, can we talk about what all that means for the Federal Reserve? And I'll share a quote with you from Andrew Hollenhorst over at Citi. This is what he said, quote, "The growing rate differential between the US and other countries is yet another marginal factor that would encourage the Fed to follow the global trend towards lower rates." How do you think this sets the scene internationally for the Federal Reserve?
Well, I would say that what we've seen recently over the last few months is a narrative that suggests that because the Fed are going to delay the start of the easing cycle, that will have spillover impacts on other central banks. Clearly, that is not the case. It does seem that each central bank is very focused on international drivers, but more specifically now on domestic drivers and domestic core underlying service sector drivers. So if you have confidence there, then you can start the process of easing. Now, with the Fed, obviously, it's at a different stage in terms of what's happening with the labor market and what's happening with wage growth. Now, we had a mix of data recently. Payrolls data was a little bit more in Powell's favor, but that doesn't necessarily mean that they're going to be able to start easing soon. So we are expecting the first hike in September and possibly just 2 hikes, whereas previously, obviously, in the dots, they were signaling 3. And obviously, the markets have shifted along those lines as well. So I think the fact that other central banks have moved won't necessarily impact the Fed decision. The Fed are very focused on that domestic labor market dynamic, and I think that will continue to be the case.
When it comes to issues of your currency weakening, because that's obviously the main nugget of why you would be concerned of moving before the Fed, Jane Foley's been really good on this idea that for Europe, where growth is anemic, the concern isn't necessarily just the landing, but what it looks like after that landing, that they would welcome a weaker euro because of the growth it brings. Would you agree with that?
I think that's true, actually. You need to think about the long-term structural outlook as well. And I think there's less of a focus on that right now. Markets are very much, when is the date? Is it June? Is it August? And that seems to be the focus. But longer term, we need to think about the divergences across economies. And I think that's absolutely right. And I think when looking at that yield spread from Fed to other economies, euro area is one place that it has an impact, but obviously Japan, we've seen this week, there's been a huge focus on the yen. And as mentioned earlier on in this program, Governor Ueda has had to have meetings with Kishida, and potentially they will be forced to raise rates themselves a bit sooner than originally planned. There is a dilemma there between managing inflation and also managing the FX impact and how that has broader spillovers across corporates as well. So it's a very challenging backdrop as a result of this yield differential between the US and other countries, but each country has to deal with that in a very specific manner. So the euro area impact will be very different to, say, Japan or APAC in broader APAC economies. So that's something that leads to more divergence and opportunities for markets.
Really well framed. Sri, wonderful to hear from you. Sri Kutchagovindan there of Aberdeen. If you are just joining us, welcome to the programme. Just recapping a Bank of England rate decision, rates unchanged as expected at 5.25. A change to the vote, though, of the 9 officials on the Monetary Policy Committee, 7 voting to leave rates unchanged, 2 voting for a cut. That's an additional member of the MPC voting for a cut since the last meeting. The guidance is interesting. Risks from inflation persistence are receding. Optimistic things are moving in the right direction. More on that guidance in about 15 minutes' time, 16 minutes away, that news conference. For the price action, bid in the front end of the yield curve over in the UK. Gilts rally at the front end just a little bit, yields lower. And if you're looking at sterling, we are weaker on the pound by about 1/3 of 1% against the US dollar. That's the price action over in the UK. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Shonali Basak. Hey, Shonali.
John, shares of ARM falling in the pre-market. The chip design maker gave a lackluster revenue forecast for the year, raising concerns that the tech industry's AI spending spree may be slowing. 3 months ago, an upbeat forecast sent ARM shares soaring and helped the company turn into an AI darling on Wall Street. The stock was up 41% this year through Wednesday's close. And shares of Airbnb also falling in pre-market trading. The company posting revenue that beat analyst estimates but provided lackluster guidance for a second consecutive quarter. The company, which specializes in shared home and vacation rentals, said it sees growth slowing before an uptick in summer travel, and it's expecting revenue growth to re-accelerate in the third quarter as key international events like the Summer Olympics in Paris and the Euro Cup in Germany fuel travel demand. And some distressing news in the housing market. Approximately 1 in 37 homes in the U.S. now considered seriously underwater. Nationally, 2.7% of homes carried loan balances of at least 25% more than their market value in the first few months of this year. And that's up from 2.6% in the previous quarter. Kentucky, Mississippi, and Oklahoma saw the biggest increase in number of homes seriously underwater. And that's your Bloomberg Brief, John.
Hey, Shonali, thank you. We'll catch up with Shonali again in about 30 minutes' time. Up next on the program, the importance of earnings.
This is an earnings-driven market. If companies are not showing investors what they like, they're getting punished very quickly.
Saw that with ARM again this morning. That stock is down in early trading and down hard. That conversation just around the corner from New York this morning. Good morning. Live from New York, welcome to the program. Equity futures here negative by 0.1% on the S&P 500. AMH is down in Washington. We'll catch up with Annmarie in about 10-15 minutes time. Lisa's going to be off for the next couple of days. I've got Danny Berger alongside me. Yields are higher by 2 basis points on a 10-year, 4.5121 on a US 10-year. Under surveillance this morning, the importance of earnings.
This is an earnings-driven market. You think about 2023, that was all about repricing. It was all about multiple expansion. And because of that, the market is not cheap. And this is a year where stocks are going to be driven much more by earnings, by cash flow, by profitability. If companies are not showing investors what they like, they're getting punished very quickly.
Here's the latest this morning. Stocks on pause following the biggest 4-day advance so far this year. Eric Friedman of US Bank Asset Management writing this. We used equity and commodity market weakness in April to add to risk assets and sell bonds, leaving us overweight domestic equities and real assets and underweight fixed income. Eric joins us now for more. Eric, great to see you, sir. In your words, you've been trading up a storm. Can you walk us through what you've been doing and why?
Yeah, we've been active, Jonathan. I think it's been an environment where we've been using price weakness to really bolster our thesis, if you will, that we think corporate earnings will deliver this year. We also want to be protected against what we think may be an incipient inflation environment. So, we've looked at equal weight S&P as our more favored choice right now, just with a viewpoint that we want to stay in large cap, we want to stay domestic. But we also want to be more spread out, if you will, from a factor standpoint. So we think equal weight S&P is a good way to express that view. Also think that inflation is going to be hanging around. In fact, it could reaccelerate as we get deeper into this year due to both the catalog costs, if you will, shelter costs, but also just the considerations around comparables. So we think that those are two spots. We're not looking for a shock and awe, if you will, in inflation, but we do think the gradual incremental increase is a risk that we want to make sure we have protection on in portfolios.
Your favored sectors, tech, energy, financials, mid-caps. I'm putting this all together, Eric. This screams strong nominal GDP. What's your base case for this economy?
Yeah, we think the economy is still going to be really in the back of both a consumer, which is starting to incrementally slow, but is still in good shape, Jonathan, and also think the corporate CapEx cycle remains quite robust. That's something that we've seen a lot through this earnings season. The themes that you've seen in terms of spend remain AI, remain cyber, remain big data. So those are things that we think are more durable. To your point on nominal GDP, we are starting to see some participation from across the pond, which is a good thing in terms of the consumer really hanging in there, financials also being in relatively good shape. So those are all things that we think still leave us more with an overweight position bias, if you will, but also a flexible mindset. I think this is an environment, Jonathan, where if you don't have tight stops around your views, there's a level of hubris that we prefer not to have in this environment. So we think, again, more of a constructive bias, but also making sure that we're not risking too much in what's going to be a very dynamic back half of this year.
Well, perhaps part of that hubris, Eric, is also having protection for when things go wrong, for when your viewpoint doesn't play out, and for an economy that we're still unsure of. But when you look at things like the VIX of the VIX, there's nothing there. There's no one who is willing to go out and buy, frankly, these cheap hedges, Eric. So what does work in this environment?
Yeah, Danny, I worked alongside Sandy Rattray, who developed the VIX many, many years ago. And it's something that I think is a great observation just because the vol has been very, very limited. So we think doing the following makes sense. Number one is that we're underweight fixed income, as Jonathan mentioned, but we do own some what we consider longer duration exposure in the event that we're wrong. That's something that again, we think makes sense in the event that there is a significant surprise with either the Fed or a deflationary pickup, which again, we are not forecasting as our base case. We think that makes sense. We also think, again, that commodities exposure, which again is not energy related in terms of energy equities, but direct commodity exposure, again, that broadening out of inflation risk that you're seeing in everything from wheat to coffee to cocoa, those are things that we want to make sure that we have in portfolio. So again, having a view, having a tight stop around those views, we think that's going to serve investors well in this environment.
Well, Eric, you also said one of your views, equal weighted S&P. This is a market where over the past decade, if you had said to someone, valuations are too high, you shouldn't go perhaps to a market weighted index, you would have been wrong because the expensive companies could keep getting more expensive. John mentioned this. You look at something like an ARM earnings that is getting punished. And Eric, I wonder how much of that is down to expensiveness. Something like ARM, 27 times sales, more expensive than NVIDIA. Is this a market that cares, once again, about valuations?
Yeah, Danny, I think that's a really important observation. We think it absolutely is. In fact, one of the reasons why we went more equal weight is because that value factor, again, not that we always invest in factors, if you will, but because of our desire to want to stay large cap, we do think there's a risk of refinancing with small caps as well as the unprofitable nature of about a third of that index. Even though it's certainly lagged, we'd actually prefer to be in a higher quality lagging index like equal weight S&P. So you are seeing that stand and deliver type of market from companies right now. If you do not either have strong guidance or a good reason why you missed, this is a market which is quite punishing. So we think that there's a level of margin of safety, if you will, in equal weight that's certainly not the cheapest we've ever bought, but a space that we think is going to be well represented in a decent earnings climate for the next couple of quarters.
Well, Eric, usually the value trade does well in a rate cutting cycle, or at least when we're in that trajectory, getting to that trajectory. So how much of that is dependent on the Fed actually delivering cuts?
Yeah, we think that if there isn't one, or at least I think it's been a great phrase that you all used this morning, which is the dovish pause, if you will. If there isn't more of that dovish pause type of language, or ultimately we think one cut and at least a signal for a bias towards more, this is a market which is a bit more vulnerable. But again, for us, it's not so much when do the rate cuts start. We do think the market's starting to pay a lot more attention to the terminal value. And if you look at, again, expectations out through 2025, 2026, again, for someone who doesn't know what he's having for dinner tonight, it's hard to look out that far. But this is an environment where, that terminal rate, if you will, is becoming more important. So some cuts this year with a signal and a bias for more in 2025 are important. Not necessary. We think the terminal rate is much more important. So again, that 2 3/4 to 3 on a terminal rate side, we think would be a good place to anchor on. Higher than that would be an issue for this market.
Yeah, never mind 25. I'm struggling to get beyond next week. CPI, retail sales. Eric, it's good to hear from you. Eric Friedman there of US Bank Asset Management. An interview, a conversation which just screamed strong nominal GDP in America.
It does. I mean, again, I go back to this idea of value. In order for value to work, you need some sort of cyclical upswing, because the way that cheap companies become not cheap companies is they deliver good earnings. So it says a lot about where you think you are in that cycle if you're willing to make that bet, which, by the way, so many people over the past decade have said, now is the time for value. And it's basically always been a head fake.
Based on what he just said, overweight equities, overweight real assets, overweight commodities, underweight bonds. That is a very constructive outlook on the US economy. Coming up on this program, former World Bank President David Malpass with Annmarie Hordern down in Washington, D.C. That conversation is just around the corner from New York. This is Bloomberg. So here we are, 2 hours away from the opening bell with equities pulling back just a little bit. We're down by 0.2% on the S&P 500. On the Nasdaq, we're down by about a third. Your next stop for this market in about 60 minutes' time. Jobless claims in America just around the corner. Very light on data this week, as we've said repeatedly on this program. Very heavy on Fed speak. More Fed speak a little bit later. San Francisco Fed President Mary Daly coming right up. In the bond market, we look like this on a 2-year. The front end of the curve, 484.48. Yields higher by almost a basis point. On a 10-year, higher by 2 at 451.41. We need to talk about some central bank rate decisions. Let's take a quick sneak peek of what's happening with sterling in the FX market. Cable shaping up as follows. The pound against the US dollar, 124.56. We are softer by about a third of 1%. That is a weaker pound sterling. Following this, under surveillance this morning, the Bank of England keeping rates on hold for a 6th consecutive meeting. 7 MPC members voting for no change, 2 voting for an immediate cut. Officials also cutting their inflation outlook as well. And Danny, for a lot of people, that just sort of nudging this decision out to June. And a lot of people encouraged by this idea that maybe that's when we get that 25 basis point cut.
The market is starting to go there. It's not completely there. Gilt's little change this morning, but what we are seeing under the surface are pricings for futures for the BOE completely in August now. So we do have that priced in, because for so long, this has basically been trading on when the Fed goes, maybe the BOE will go. It was following that pricing. We're starting to see a change, and Deutsche Bank really underlines this. They game this out, basically saying, actually, the risks to sterling are not that great if the BOE goes before the Fed. The move will basically be an error, a rounding error. So therefore, they can go. The currency effect is not bad enough to hold them off, much like we saw from the Swiss and from the Swedish.
I'm guessing we read the same note, because
Probably.
This was from Jim Reed of Deutsche Bank. Was
Correct.
it from Jim?
It was from Jim.
Okay, so Jim had this to say about the Bundesbank. So if you need a long history of the ECB, we only have so much because the euro is only a couple of decades old. So if you include the Bundesbank and just say that's the same thing. So this is what he says. The Bundesbank ECB have not eased before the Fed, apart from in 2011 when the ECB cut rates due to the sovereign debt crisis, when the Fed was already at zero and didn't cut rates further. So this is a history going back to 65 years ago from Jim Reed of Deutsche Bank, where on the ECB/Bundesbank, it's very, very rare for them to go before the Federal Reserve. And we're about to see that potentially next month.
Maybe it's because this isn't exactly a rate cutting cycle. I mean, if they're going to cut once, twice.
I think that's the right point.
I mean, it's not the same as it used to be. They're not going to have this huge difference because inflation is not where it is. So it's, again, not the same type of impact if you start your cutting cycle, quotes, cutting cycle a month, 2 months before.
Maybe a mid-cycle adjustment. I think that's a phrase I've heard quite a few times, both here in the United States and elsewhere as well. That's the latest on the central bank stuff. Here's the latest on individual names. Shares of Warner Brothers Discovery trading lower after wider than expected losses and a revenue miss. Bloomberg reporting the company is looking for further cost cuts, including possible layoffs. And in a surprise move announced yesterday, Disney Plus, Hulu and Max will be sold together in a bundle starting this summer. We have long talked about this, Danny Berger. The return of the bundle, it is back.
I can't get my head around it. It feels like at some point there are so many bundle offerings. I'm like, this is cable TV. That's exactly what you're selling. It's that jam problem. You go to the grocery store, there are too many jams, so whichever one you buy, you're unhappy with. This is the world we're getting into with these bundles.
And you end up with a fridge full of jams.
It will.
Which is what the TV looks like now.
I mean, I think the point is you buy one jam and you hate that jam. So in this scenario...
Do you throw it away, though? I thought you ended up with the fridge... Anyway, we'll leave that story there.
Expired jams everywhere. And the bundle you don't watch. I think that's it.
I think that's a British thing.
Something.
That is definitely a UK thing, to have a fridge full of jams. I don't see that in America so much. Here in the United States, President Biden's so-called red line on a Rafah invasion is becoming clearer. In an interview with CNN, Biden warning he'll stop additional shipments of weapons to Israel if it launches a ground invasion in the Gaza City. The US already pausing a shipment of 3,500 bombs. Rare to hear from the President of the United States directly in an interview. We actually got one yesterday evening, and very, very clear about what he thinks should happen next.
And it's a different Biden than we heard in March. He gave an interview to MSNBC there, basically saying going into Rafah, and a Rafah invasion, that is a red line. But John, he caveated that with saying there is no red line in which I would stop supplying all weapons. Now, to be clear, he's not stopping supplying all weapons, but it's a change in tone. And to your point, it's a public change in tone that he's giving on an interview that he rarely does. It is Biden trying to make a point to the Israelis.
You know, the commentary I always hear on this side of the Atlantic in the United States on the president is often, this is really important to his re-election chances, particularly in states like Michigan. And I mentioned this earlier on in the programme, and I know a lot of other people have identified the same thing. When you go through swing state polling, Michigan is the least of his worries. In our recent poll with Morning Consult, he's up there. He's down hard everywhere else. If you take an average of all swing states, he's down 6 against the former president.
And one of the things I go back to, one of the things that polls extremely well that Biden has an advantage over, things like abortion rights. You don't hear Biden out there talking about that. Obviously, current events have taken over, but the messaging is the war, the messaging is the economy. There's low-hanging fruit there. It feels like he's not getting after.
Yet the economy very much top of the pile. Sticking with politics, 6 months out from the November election, and the next president could be heading into a, quote, perfect storm, according to former World Bank President David Malpass. Writing in the Wall Street Journal, Malpass saying, quote, the suspension of the debt limit expires January 1. This year's spending bills will likely be extended just long enough to kick the can into 25. And tax rates will rise at the end of 25 unless Congress and the president can agree to expend some of the expiring provisions in the 2017 Tax Cuts and Jobs Act. Annmarie Hordern, joined by David Malpass in Washington. Morning, Annmarie.
Good morning, John. That's right. I'm joined by David Malpass, the former World Bank head and also Undersecretary at Treasury under the Trump administration. Thank you so much for your time. John outlined some of these thoughts that you have going into next year. This perfect storm, the debt ceiling, the perennial spending fights that happen in Washington, and also this expiration of the Trump-era tax cuts. Whether it's Biden or Trump, how should the next president be thinking about all of this?
Morning, Annmarie and John. You have to recognize what's been going on politically in D.C., which is not making decisions, not really sorting out what to do about spending, about debt, about taxes. And so that's all pushed into 25. And that has an impact on businesses. They wait to see. So the uncertainty, I think, is what's prevailing within the economy. I don't want to invest if there's going to be a big tax increase, but I can't see what they're going to do to avoid it. And so that's the time clock that's going on now.
I'd like to talk about taxes because Ed Mills was on from Raymond James earlier this morning, and he made a great point, which is the fact that yesterday we heard from the House Ways and Means Committee Chair Jason Smith coming out and saying there's actually some Republicans who want to see a higher corporate tax rate. Trump brought it down to 21% from 35. Biden has pitched 28. Senator Joe Manchin has said maybe 25 is something we can all agree on. Where do you see Republicans and Democrats potentially having this equilibrium when it comes to the corporate tax rate?
It's a bit of a fight in the election itself. You've got a choice of, do you want the economy to grow stronger, and do you think tax rates matter? I think they really do in terms of the growth rate. If you raise the taxes, there's less investment going on in the corporate sector. We're already seeing it in the small business sector, just very hard for them to make the new investments needed to pull down or to improve the supply chain. So we're seeing this persistent inflation and stagflation.
So what do you make of Republicans, though, coming out and saying that it should be higher?
You know, all through, the party unity is not as much in the Republican Party. So they've got to sort out what is the message of Republicans, that you want Washington to be bigger. You know, it'd be fun for a lot of politicians in Washington to have a big debate over which taxes to raise. That pulls in a lot of political contributions. But what we should be looking at is which taxes affect growth the most, and you want to hold those down so that you can have more jobs, more people back to work after COVID. A lot of people are just staying out of the economy because it's not strong enough to bring them into the labor force.
Well, the labor participation rate, though, is pretty high, and unemployment is below 4%. Most people would argue and would say this is a very healthy labor market, under 4% for more than 2 years.
The labor force, though, doesn't include the people that have opted out. And those are people that we need in the economy in order to really be catching up. In the meantime, China's numbers yesterday, they show their trade numbers. They're cleaning up by having factories running at full speed. I'm from Michigan. What you see is the manufacturing inventories not building. People, you know, the whole U.S. economy is waiting to see what's going to happen in terms of policy in 2025. That's this fiscal train wreck. And they want to see how is that going to be resolved by Washington to get Washington out of the way. What we're seeing right now is this regulatory push that's going on day by day. You're seeing these massive new regulations come out of Washington as an end point to the current administration. Also, the proposals for big tax increases that you're talking about, that yes, there's going to be some Republicans who say we need it, but I think the public recognizes if you give more money to Washington, it's just going to be spent. So it's not really going to help on the national debt front.
When it comes to the national debt and taxes, the CBO came out yesterday and said if we were to see an extension of the Trump-era tax cuts, $4.6 trillion. So fiscally, this would be incredibly challenging. How do you think about that? Would the bond market even allow that to happen?
This gets into what are the taxes and how do they affect growth. There's this tendency of people to do what's called static modeling, meaning they say if nobody changes their behavior, then a tax cut will just be added to the national debt. But the whole point of taxation is to raise revenue without stopping people from doing what they need to do. Small businesses reinvesting. I think we're over the Laffer curve right now in terms of small business taxation. I don't know if you saw the statistics as President Biden has proposed these big tax increases on capital gains and also on basis step up. It causes small businesses to just stop investing in their business. They look to sell to somebody big because they can't afford the taxes. So I challenge that $4 trillion statistic and say, look, you would get more growth out of the economy if you had better tax policies. You don't need to raise the corporate rate.
Okay, well, that's going to be definitely day one something, and we already see committees being formed now in Congress to try to map out what this tax policy will look like. I want to also ask you about what potentially we could see under Trump 2.0. You were an economic advisor for him when he was campaigning in 2016. You joined the administration. You ran the World Bank. When the Wall Street Journal comes out with a report and says that Trump potentially wants to put his thumb on the scale when it comes to the Fed and questions Fed independence, do you think that actually would be happening?
I saw that story. There weren't any sources. I don't think that is the policy that would create growth. You know, the Fed has, I've criticized the Fed for being too big, for inserting itself into too many markets. The interbank market is gone now. The trading of Fed funds that were so vital to the dynamism of the U.S. economy, that's gone. The repo market has been almost nationalized as you look at the amount that the Fed is controlling within that market. So I think we could have a smaller Fed, a smaller balance sheet for the Fed, and that would actually be very positive for growth. The commercial banks would love to be lending right now to small businesses, but the way the regulatory policy works, they can't do it. It's biased against small businesses. And that's true also of the borrowing that's done by Treasury and by the Fed. They're borrowing in the short end of the curve, and that's just crowding out small businesses. So I think that's the key dynamic going on.
But they're borrowing the short end of the curve because everyone thinks, why lock in rates this high at the long end? We'll do that maybe in 2 years when they come down, right? I mean, isn't that prudent?
No, that's not prudent. The yield curve is deeply inverted. So if you borrow at the short end, you're paying this 5.4% by the Fed. They're borrowing every day at 5.4% to own bonds that yield substantially less. That's not prudent. What it does do is helps prop up the stock market for now. I think there's some end game going on within the economy where it's part of the kick the can is to say, well, let's just borrow short term, hoping for better in the future. But the global markets look at that, and they're not voting for the United States on that. We're weak at home in terms of the economy, just 1.6% growth, and CBO's forecasts are for weak growth into the future. And then abroad, we've also got the weakness that's leading to wars in multiple parts of the world. And they look at the fiscal situation in the U.S., the inverted yield curve, and say, Why would I invest into that high a short-term interest rate?
Two final quick ones. So one, you think under Trump there would be an autonomous Fed, and two, would you go back into a Trump administration?
Right now that's way premature. The issue is for people to sort out the policy differential. You've got a choice of weak versus strong, of growth versus stagflation. That's the decision for people to make. And Trump would have a whole array of people that could really implement a growth policy. I think that's quite possible, but it's the election cycle. So let's focus on that.
David Malpass, thank you so much for your time this morning.
Thanks.
John, of course, that was the former head of the World Bank, David Malpass. He thinks potentially we're going to a stagflation environment. We should remind the audience what Jay Powell recently said about that. He doesn't see any stag or any inflation.
AMH, thank you. On the challenges of 2025, the World Bank president, former World Bank president, David Malpass. If you are just joining us, welcome to the programme. I want to check out sterling just quickly. The pound weaker against the US dollar, down 1/3% at 124.58. The Bank of England 45 minutes ago, leaving rates unchanged at 5.25. The news conference on Threadneedle Street underway. Governor Bailey saying it is likely we will need to cut the bank rate. We will need to make policy less restrictive. Rates may fall more sharply than markets expect. So, hello, June, maybe. Take a listen to what he had to say about the month of June. A June bank rate cut, Danny, is not ruled out or planned. Helpful.
Very helpful. That's how I find basically all of his comments. And one, he says, don't interpretate the ups and downs of data. Oh, but also we need the data to help us interpret where the CPI is. John, I think you put it really well, that this is about giving himself optionality. But you can see in those last comments, he can't help himself to have that dovish tilt. It was only in January of last year. Remember that whole thing of we're turning a corner, yes. We're almost there. And here we are over a year later. We're not really, maybe we're kind of almost there. You can still see that impulse from him creeping out.
It's like a 3-month rolling view.
Yeah.
It's always 3 months out. Maybe it's another 3 months out. Sterling's weaker by about 1/3%. Cable at the moment at about 125. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Shanali Basak. Hey, Shanali.
Hey, John. Chinese President Xi Jinping appears to have wrapped up his trip to Serbia without visiting the site of the former Chinese embassy bombed by NATO forces. Xi timed his arrival in Serbia to coincide with the 25th anniversary of the bombing, where U.S. missiles killed 3 Chinese journalists. The White House later called the strike a mistake and blamed it on faulty maps. Xi wrote an op-ed published in a Serbian Politika newspaper on the day of his arrival, vowing to never forget the attack. MAGA has joined TikTok. It's the first Trump-affiliated account on the Chinese social media app. The super PAC's first videos posted under the handle @MAGA attack Biden's economic record and label the independent presidential candidate Robert F. Kennedy as a radical leftist. Trump and President Biden, who has been on TikTok since February, have both supported a ban of the social media app due to national security concerns. And living in Manhattan is getting even more expensive. Apartment rents rose to a new high for April. Leases were signed at a median of $4,250, up $9 from the same time a year ago. That's according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. Rents have climbed annually in 3 of the past 4 months, suggesting that another record-shattering summer is to come. That's your Bloomberg brief, John.
Shanali, thank you. We'll speak to Shanali again in about 30 minutes. Here's the deal. Yes, it's a lot of money. People are paying it. This is what stands out for me. Leasing has soared 42% up on last month in April over 2023.
You're just tempting this rant from me about how there are too many people in New York.
Indulge me. I'll be with you. I'll be on board.
There are just too many people here, too many people willing to pay that. You know, it's the bank, the consultancies, they all overhired. They're still here and paying those rents.
Inventory in Manhattan rising 23% from a year earlier. So that churn that they're speaking to is starting to happen. It's a lot of money, but people seem to be paying it here in Manhattan. Up next on the programme, the case for commodities.
We have already shifted towards commodities with an overweight there. A commodities position we think is probably a smart thing to do at this point.
We'll catch up with the brilliant Javier Blas up next. Equities pulling back, stocks down by 0.1%. No drama here. Yields are higher by a single basis point on a 10-year, 450.62, and crude rallying by 0.7%, 79 $1.55. Under surveillance this morning, the case for commodities.
We have already shifted towards commodities with an overweight there. Again, the non-correlation, we like that about commodities. We've certainly seen precious metals performing well, gold in particular, and we think that oil does have some upside from here. So, a commodities position we think is probably a smart thing to do at this point.
Here's the latest this morning. Soft commodities rallying this year with extreme weather and shortages driving prices of coffee and cocoa higher. Javier Blas of Bloomberg Opinion explaining one more reason why coffee is rallying, writing this. For long, coffee was one of the few commodities that one could still analyse without paying much attention to China. That's not the case anymore. Javier joins us now for more. Javier, talk to me about that. How great a source is China now of demand for coffee?
Well, you were looking at the coffee market 20 years ago, you didn't even have to think about China. Even 10 years ago, China was not even on the top 15 consumers. Today is the 7th largest consumer. This is from a country that has been always, almost synonymous with tea consumption. China now is a big factor in the coffee market. It's not the main reason why coffee prices for Robusta, that's the cheaper bean, are the highest in 45 years. That's mostly weather in Vietnam. But it's increasingly a factor in the market and a factor that we need to consider.
Javier, how much of this is about the fact that it's a cheaper bean, that it's not the expensive stuff that, people who can afford it will keep paying up for?
Well, it is a factor. I mean, let's look at the fundamentals of the Robusta coffee market. The biggest producer is Vietnam. It has suffered with a heat wave, drought, so that has been denting production. And we saw roasters of coffee last year. They were very aware that we were living on a cost of living crisis, that consumers were going to probably trade down and try to get cheaper alternatives. So the demand from the roasters for Robusta beans went up in expectation that there will be more consumption for it, and expecting that the supply was going to be there. Then the supply was not there because of Vietnam, and that's the combination, that increase in demand coming from the roasters, expecting that the need for a cheaper blend, and then the supply failure, the crop failure in Vietnam.
Well, usually it's the demand mechanism that sorts this kind of thing out, Javier, that it's really expensive now. So you get someone like a Starbucks where people are less willing to buy their fancy coffee drinks, so therefore they're not selling as much, they're not buying as much. But you mentioned the big issue here is the supply issue. Do we need to start thinking about these soft commodities in a very different way, considering what climate change has done in terms of storms and extreme weather?
I think that we need to think about soft commodities as being always exposed to weather. Coffee in particular has been particularly exposed not to heat waves and droughts, but mostly to frost in Brazil. We have big frost in the 70s that really damaged the crop. In one weekend, at what point in the mid-70s, we lost half of the crop of Brazil just because we have a big frost, and that was it. But I think that we need to see these commodities as areas where the demand continues to increase, where the elasticity of demand to prices is very low. We are going to still consuming a cup of coffee every morning, almost no matter what the price is. And where, let's be honest also, the price of the commodity makes a very small fraction of what we pay on the Starbucks. That's a lot about salaries, a lot about marketing, a lot about the profit margin. It's very little of that, whatever it is today on the Starbucks. Every time I visit New York, I'm really shocked by the price of a coffee in New York. That has very little to do with the price of coffee in the market.
I appreciate the complaint. A lot of people agree with you. Javier, just quickly, this is softs. It's not just softs, it's hard as well. Copper has rallied. It's all about supply there too. See the same thing in iron ore. Iron ore starting to pick up as well. Would you go as far as calling this a perfect storm for commodities on the supply side?
I would not say that. I mean, you look at other commodities, wheat, corn, soybean, prices are coming down, rice prices are coming down, even olive oil, which I care a lot, the prices are starting to come down. But there is an element of supply shortages in some commodities. I think that copper certainly has a lot of upside to go up in the next few months and years. Oil is a bit more balanced, supply and demand are balanced. The price is going to stay between the range that we have seen so far this year, between $75 and $95 a barrel. So I would not go to say there is a very bullish story for commodities in general, but certainly for some of them there is a bullish picture.
We should avoid the olive oil argument. Javier, let's leave that there. Javier Blas of Bloomberg Opinion. Javier, enjoyed the article. As always, sir, thank you. Lots to talk about this morning. Underway at the moment, a news conference with Governor Bailey of the Bank of England. Here's another headline for you, Danny. No law that says the Fed must move first from the Bank of England.
I love the idea that there would be a law like this. That's a great idea, Andrew Bailey. We should get that.
Sometimes we have conversations as if there is a law that we have to wait for the Fed. More on that in just a moment. We'll catch up with David Leibovitz of JP Morgan, Pooja Sriram of Barclays and Bloomberg's Geeta Raghunathan and Mandeep Singh. That's all coming up next from New York. This is Bloomberg.
In terms of the soft landing playbook, that's still up in the air.
We do think that we're going to see more of a soft patch.
I think it's important to recognize that the balance of risk has shifted when we talk about rates.
I think every meeting is open to the Federal Reserve. You either go in September or we wait until December, but I wouldn't rule anything out.
Their biggest concern is if things go south, how fast do they go south and what do we really do?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
So last week we were overwhelmed by economic data, and we've said all this week that we're light on data. A sprinkle of it this hour, 8:30 Eastern Time. Jobless claims just around the corner. A little bit more Fed speak this afternoon, going into tomorrow and onto the weekend. We need to talk about 8:30 Eastern Time. Jobless claims. We'll get our hands around this economy and what it means for the Federal Reserve, and what the Federal Reserve means ultimately for everyone else. And at the moment, not much, it seems. We've already had a cut from the S&B out of Switzerland. We've already had a cut from the Swedish over at the Riksbank. And the Bank of England saying this, Danny, just moments ago, no law that says the Fed must move first for us to make a move.
That is indeed correct. There is no law that says they must do that, but we've heard this from Lagarde, right? And basically every ECB speaker saying that we don't need to wait from the Fed. The Swiss and the Swedish showed us that indeed they don't need to wait for the Fed, but the calculus, John, becomes different if we're talking about waiting for the Fed past this year. What happens if the Fed doesn't cut this year? What happens if they don't cut until late 2025? And they've already started their cutting cycle. That's perhaps when you get the trickiness.
This is where rate differentials get a little bit more difficult for some of these central banks. It might not shape when they start. It might shape how far they can go. And we'll have that conversation in just a moment. Andrew Bailey, the governor of the Bank of England, speaking in this news conference, underway, started about 32 minutes ago, had this to say on the outlook for inflation. 2 more prints before a June rate decision. And the MPC now sees the second round inflation, if we can call it an inflation shock, fading faster than previously anticipated. So things seem to be inching towards a 25 basis point cut from this central bank.
He also, though, did say that he expects inflation to edge up later this year. So wrap your head around that. He's saying 2 different things potentially at once, but it just goes to show that they don't exactly know the path of things going forward. He made the mistake before of saying we're going the right direction. Here he is giving himself an out if it doesn't go that way.
It's a word you hear a lot on Wall Street. It's optionality. They always want the option in either direction. The pound against the US dollar a little bit weaker by a couple of tenths of 1%, in at around 125 at the moment. The broader price action, we're down 0.2% on the S&P, just a little bit weaker going into the opening bell in about 88 minutes time. In the bond market, yields are higher by 2 basis points. The 10-year 4.51.41, and a broader look at the FX market beyond sterling into the euro weaker as well against the dollar at 107.29. Coming up this hour, we'll catch up with JP Morgan's David Leibovitz as stocks snap a 4-day winning streak. We'll speak to Mandeep Singh of Bloomberg Intelligence as chip makers become a geopolitical flashpoint, and Pooja Sriram of Barclays on what it would take for rate hikes to re-enter the conversation. I can't keep up. We were talking about hikes, then cuts, and now hikes again. We begin with the big issue. Awaiting the next big data point. Market momentum stalling as investors look ahead to next week's CPI print. JP Morgan's David Leibovitz saying this: for investors, so long as the Fed remains biased to cut rates at some stage, we think risk assets will remain supported. David joins us now for more. David, good morning to you.
Morning. How are you?
Is that the bias, and did it change last week in any way, shape or form?
So it's funny because when we think about and when we talk about what happened last week, I would describe the market as almost spastic, right? We started with a very hot ECI print that everybody was pricing out cuts. The Fed's not going to be able to go this year. We ended with a non-farm payroll report, which was effectively Goldilocks. So there was something for everybody last week, and you could see that in the way that the market was moving. I think the most important thing was what Powell said during the press conference. And when he laid out the potential scenarios for interest rates this year, he didn't really talk about hikes. He talked about staying on hold. He talked about easing policy. And we've actually done some work and looked at whether it's the stock of cuts that the market is expecting or more about the flow. And as long as the market is continuing to price in cuts over the next 12 months, we think that that's going to keep long-term rates in a range and likely leave equities fairly well supported.
So let's do some scenario analysis. So Christian Mamani was sat in your seat just yesterday, and he was saying there's two worlds. There's one where the economy's great and the Fed can't cut, and there's basically one where the economy starts to soften and the Fed can. Right. Is there a better outcome for markets?
You know, I don't think there is. I think that the latter may be slightly better for the market. The market is clearly getting a little bit twitchy about this very robust pace of nominal growth. And the issue is you're getting the earnings coming through, but you're capped on multiples given the subsequent outlook for rates. And so I actually think a little bit of softening in economic activity, maybe getting the Fed to acknowledge that easier policy really is on the horizon, that could be the ideal scenario. Very much going back to a world that feels like the one we were in for the better part of the expansion post-GFC.
And you can feel the market's desire to get back to that. We keep referencing back to that. But I wonder in what you were talking about Powell laying out all these scenarios where he very well could have said that would lead us to hike. He says that would lead us to not cut. Is that the Powell put?
I think to an extent it is. And I also think it's important to recognize what the issue is that they're dealing with, right? So the Fed has this dual mandate for full employment and price stability. They don't really need to be worried about the employment situation, at least given the data that we've seen. And so inflation remains public enemy number one. And what I think would lead the Fed to become more hawkish is if we saw that reacceleration in inflation, which in our view would be directly tied to a labor market that heats right back up. And so if we see non-farm payroll prints go back to 300,000, that could well give us a bit of pause. But it feels like the overall direction of the labor market and the wage data is supportive of some easing later on this year.
And then we have a quiet week. We get some more of that data next week. But here's the thing is, it seems like we're in a bit of a no man's land during that data because earnings season will be over. We won't have all those cues for corporations. We're a far ways out now from the next Fed decision. So what does it mean for each of these data points when we're kind of in the middle of nowhere?
Well, it's interesting because to your point, it's really the level one data, right? The CPI numbers, the employment numbers that tend to move rates and subsequently equities. In particular, I actually think that it's not the worst thing in the world. We have a somewhat quiet week. The market can digest what it learned last week. I mean, we got a lot of data last week in the US, around the world. The market can process that and the market can listen to what Fed speakers have been saying, right? We're seeing, relative balance between those that are continuing to talk about easing later on this year and those that may be a little bit more hawkish, like the man from Minnesota and his blog yesterday. And so, when we think about what the market is going to do this week, it's going to digest that data. And frankly, the outlook for the economy looks pretty good. 2Q growth is tracking nicely. We may see a bit of a deceleration in the second half of the year, but again, back to where we started the conversation, I'm not sure the market would dislike that.
But the bar is higher, and we need to talk about that data relative to expectations. So let's take the City Surprise Index, looking at US economic data incoming relative to what we were expecting. It is nosedived over the last month. It's turned negative in the last week. Do you think there are better opportunities abroad? Do you think we've reset the bar low enough abroad that we're starting to beat expectations at the same time they're starting to deliver rate cuts?
So the international story is an interesting one. The thing I will say about the U.S. economy before we move on to the rest of the world is we were thinking about the various kind of pillars of growth as being assets or liabilities or neutral. There's a lot in the neutral bucket today, but that does skew a bit more toward the liability side than the asset side. And I think that that's supportive of slower growth in the U.S. during the back half of the year. Now, the counterpoint to that is the rest of the world is picking up. Right? If you look at kind of the edge of the world being Southeast Asia, what's happening with semiconductor activity and overall technology exports, things have picked up quite nicely. We're seeing some green shoots finally begin to emerge out of Europe, and that makes us constructive on a pickup in the overall global manufacturing and global goods cycle. And frankly, what we need to see is the European consumer come back. Because if the European consumer comes back and that source of demand reemerges, we'll see the inventory cycle pick up, we'll see that manufacturing activity reaccelerate, and we'll see Europe emerge from a relatively soft period of economic growth.
What is it about the phrase Europe and green shoots? I feel like we say Europe green shoots for like 10 years. Same story.
Exactly. I think it's definitely become convention, but I think that the reality here is that you've seen an extended period here, 18 to 24 months, where manufacturing activity globally has been soft. You're not only seeing things pick up in Asia, you're seeing things pick up in Europe, you're even seeing things pick up in the US, barring that most recent ISM manufacturing print.
Okay, but once we get the cuts coming out of Europe, what happens not to the landing, but after the landing? I know you're seeing green shoots, but is it enough to get some sort of growth coming back into Europe?
So I do think that we can get growth going in Europe again. And I think, one of the bits that we've been really focused on as of late is the response to the pandemic, right? So in the US, you had, money dropping from helicopters. People got laid off, but they got a stimulus check in the mail. That created too much money chasing too few goods. Europe had a different approach, right? They furloughed their workers. They put them on a percentage of their overall salary. And I think that led the consumer to just retrench a little bit further. And so as we see consumer confidence begin to pick up, and as we see signs that the labor market is remaining healthy, that does make us more constructive on opportunities in Europe than we have been up until this point. The one thing I will say is that the folks who like to point to, well, you can invest in semiconductor producers in Europe and technology in Europe, it's as expensive as tech in the US, right? So that's a completely different conversation. This is more about picking up the cyclical trade and jumping on board as things begin to accelerate.
But it is so hard to remove the American bias and go overweight Europe. Is now that time then?
So it's a good question. The thing that's really plagued that trade for the better part of the past decade plus has been the strength of the dollar. And so I think that the way to weigh this and to think about this is if the ECB is easing and the Fed needs to stay on hold, what happens to the euro? Right? Because if we can get that euro strength and maybe the Fed easing as well, that's going to be an additional tailwind for US-based investors in European markets. If we have a Fed that keeps rates where they are and an ECB that starts easing, I think that even if you see a pickup in local market activity and local currency returns, the dollar may well work against you.
Wait, so square those two for me. European growth is better. Go into not just the expensive tech, but at the same time, by all accounts, the Fed is not going to cut as soon as the ECB. Dollar remains strong. Which wins out?
So I think if the Fed is able to ease, and our view is that we will get 1 to 2 cuts before the end of the year, you will see some of that euro strength begin to come through, and you will be able to participate in a recovery across the pond.
We've got a lot to talk about. You're going to be sticking with us. David Leibovitz there of JP Morgan Asset Management, sticking with us for the rest of this hour. This week started with a conversation about US exceptionalism and just how exceptional that exceptionalism actually is. Peter Chi of Academy asked that question. He's right to ask it based on how the data's come in relative to a much higher bar.
Yeah, and I'm going to, channel my inner Lisa because she's not here. The debt is certainly exceptional.
Okay.
Perhaps that's the exceptionalism that we see. But can a country be exceptional with this huge debt pile? It is a concern. More folks are talking about it. I don't know. Maybe it's not so exceptional with that considered.
You say Bramo, and I go straight to the Bloomberg terminal. For anyone with a subscription, ECO20 space US supply. 30-year bonds, $25 billion worth, coming a little bit later this afternoon. Bramo, if you're at home watching, that was for you. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief with Shonali Basak. Hey, Shonali.
Hey, John. Speaking of bonds, the Bank of England has voted to hold rates steady for a 6th straight meeting. 7 MPC members voting for no change, with 2 votes for an immediate cut. Officials also cutting their inflation forecast. Governor Andrew Bailey saying that he's optimistic that things are moving in the right direction. And Bloomberg is reporting that Alphabet is in talks to buy marketing software provider HubSpot. Discussions are ongoing. No agreement has been reached, according to people familiar with the matter. The deal would allow Google's parent company to better compete with Microsoft, Oracle, and Salesforce. HubSpot has a market value of about $30 billion, meaning this could be one of the biggest takeovers of the year. And shares of Warner Brothers Discovery trading lower after wider than expected losses and a revenue miss. Bloomberg reporting that the company is looking to further cut costs, including possible layoffs. And in a surprise move announced yesterday, Disney Plus, Hulu, and Max will be sold together in a bundle starting this summer. And that's your Bloomberg brief, John.
Shonali, thank you. So I'm losing count. So I've got Hulu, and within Hulu I get Disney Plus, and I get ESPN. So now I'm going to get Max as well. Is that right?
And then I think, Verizon, I think they have something where you can get Max and Netflix too. And then remember that whole thing of everyone teaming up together and also offering sports. So sorry, you thought you got to just choose between. Yes, that too. So there's, plenty of bundles to choose from.
Because separately, of course, Netflix, Prime, Paramount for the Italian football, Peacock for the British football.
Right.
This list just goes on.
You're just buying for football at this point.
I pay more now than when I first moved to this country and got cable and just had the full package with the sport and everything. And didn't pay for any of this stuff. I pay way more now than I used to.
Yeah, well, I'm just sticking to cable and Netflix. That's all. I can't be bothered, honestly. It's too much to figure out.
The bundle is back in a big way, apparently. Up next on this program, the Morning Calls. Plus, we'll catch up with Mandeep Singh of Bloomberg Intelligence as chip makers weigh the impact of new US restrictions on Huawei. That conversation just around the corner. Live from New York City this morning. Good morning. It's the price action for you on the S&P 500, negative by 0.2%. Just a little bit softer going into the opening bell, about 1 hour and 14 minutes away. It's time now for the morning calls. First up, Citi, raising its price target on Uber to 93, maintaining a buy rating. The ride-sharing company, still one of Citi's top picks, as it sees booking and profitability growth. Your second call from JMP Securities, raising its price target on Instacart to 42, sticking with an outperform rating. The analyst citing stronger first quarter earnings and the company's new restaurant delivery deal with Uber. And finally, JP Morgan raising its price target on ARM to 115, keeping an overweight rating. The analyst highlighting another positive quarter driven by a jump in chip design activity. Even with that stock getting absolutely hammered this morning, we're down in the pre-market by more than 8%. Let's stick with the semis. CFRA maintaining its positive fundamental outlook on the chip industry. The analyst Angelo Zeno saying the Commerce Department's blacklist of Huawei won't negatively impact US firms, writing this. We anticipate no change to Qualcomm's revenue outlook, as the company already cited that it planned to completely stop shipments to Huawei by the end of the year. While the impact on the industry is not a needle mover, China remains a long-term risk to the supply chain. Investors should expect more sanctions to come through the pipeline. Mandeep Singh of Bloomberg Intelligence joins us around the table for more. Mandeep, good morning.
Good morning.
Can we talk about how some of these chip makers are navigating very choppy waters over in China?
Well, so in this case, I think it may actually help Qualcomm. I'm not so sure about Intel, but Qualcomm in their last earnings call called out how they were gaining traction on the premium side. They use Android, and all the OEM makers like Samsung, Oppo, Honor, which are Huawei competitors in China, use Qualcomm processors. So in this case, if you're sanctioning Qualcomm from supplying the modem and the connectivity chips, which is also part of their business, that actually helps the other OEM Android makers who may actually see more business. So I do think Qualcomm in this case benefits. Intel, I'm not so sure, because if you're not providing the CPU that goes into a Huawei laptop, does it benefit Dell, Lenovo, HP? Not so sure about that.
The companies have been preparing for a lot of this for a long time now. Could you talk to us about NVIDIA? Reports May 22nd. What have they been doing in anticipation of some of these moves around China?
I mean, we know they have come up with a scaled-back version of their chips, and that's how they've been skirting the restrictions on the latest end of their chips. But remember, NVIDIA has got pretty much the entire GPU space to themselves, in the sense that everyone needs whatever they can make off. So even if they're making a low-end chip, market is taking it. And especially, I think the Chinese OEM companies that are trying to catch up on the AI side, they don't mind taking the low-end chip because they don't have, what's the alternative? And so in that case, I think it hasn't affected NVIDIA in a big way, barring an outright ban where you can't sell to the China market at all. That's when it will hit, I think, NVIDIA. But for now, this news is actually, it may be good for Apple too. I mean, think about it. If Huawei can't make a good smartphone, and that too, they were targeting the premium end of the market, it benefits Apple to an extent, because suddenly the iPhone is a viable alternative, and as is Android OEM maker. So I think this is targeted to driving, helping to an extent the US phone makers as well as the alternative to Huawei in China.
Mandeep, how long until the conversation turns not from what is the impact of US restrictions on China, but kind of the EV conversation of the homegrown Chinese players coming up and posing a real threat? How far away are we from that?
Well, so again, when you look at all these, car makers that are coming up with new designs, Xiaomi being another one that's quite prominent, they've come up with their own EV. They use a lot of components. So as long as you, limit the supply of those components to someone like BYD, it can't innovate as fast as a Xiaomi or a Tesla can. So I think right now the restrictions are going to that level where you really pick your spots. And that's how you can make a difference in terms of, applying those restrictions.
And how are you thinking about the overall cycle? We were talking during the prior segment that we're seeing signs that overall semiconductor activity is picking up in places like Korea, places like Taiwan. How much runway do you think this all has, particularly in light of some of the political issues that are now coming into play?
I mean, look, right now, every sovereign is trying to build as much capacity as they can on the AI side, because everyone realizes, this is the cutting edge stuff. This is what the governments need to focus on. So I'm not surprised every sovereign is investing in such a big way. and you just kind of focus on the things that really matter in terms of the early stage infrastructure. Remember, applications and software will come much later. Right now, it's all about setting up that infrastructure that can propel you to the next wave of AI and innovation that's about to come.
So it's fair to say you see more opportunity in the picks and shovels today than you do in the things like the software.
I mean, this is a multi-year secular trend, and we are still in the very early stages. And right now, everyone is trying to get their hands on as much capacity they can when it comes to these cutting-edge chips.
Why isn't the market then rewarding someone like ARM, who says our next venture is to help develop the things that go into the data center? Surely the market would say, great opportunity, ARM. Instead, we see the opposite.
Well, there is a price for everything, right? So when you're a company that's trading at 30 times price to sales, you have to ask yourself how much of the good news is already embedded in the stock price. And in this case, there was nothing wrong with the quarter. It's just the expectations had got to a point where you have to beat and raise like NVIDIA does. You know, and not everyone can deliver results like NVIDIA.
How much? Well, by the way, ARM is more expensive than NVIDIA, so that tells you something. How much of this, though, is just the fact that SoftBank still owns, 90% of these shares? I mean, there's barely any float out there. So if you want to buy, the supply is so little. Can you say that's the impact, not necessarily that expectations are really high?
I mean, I haven't looked at the short interest, but, all these things matter when it comes to when the company reports and what impact it has on the stock price, the knee-jerk reaction. But I would say long-term, the story is intact. There are a lot more ARM design wins. ARM is going into data centers as well as, in a lot of the edge stuff. So clearly, they have that wind on their back. I mean, the valuations did get ahead of themselves, and sometimes you see that sort of reaction.
It's down about 7.5% in early trading. To Danny's point, doesn't take much to push this stock around at the moment. Just to confirm, NVIDIA reporting May 22nd. Mandeep, thank you. It's good to see you. Mandeep Singh there of Bloomberg Intelligence. David, you nailed it, I think. That's the big question we've all got. How long is this runway? How many more quarters can NVIDIA keep coming out and just saying, yep, beat raise, beat raise, beat raise?
And I think that's the big question, particularly coming out of this earnings season, where we really saw that the dent in the armor was vis-a-vis the guidance. You could have beaten on sales, beaten on earnings, but if you didn't upgrade your guidance, you got completely pummeled the next day in the market. And so how long can these companies maintain these growth rates? I think you make an excellent point about the fiscal impulse when it comes to all of this and the sovereign spending that's being funneled in. But at some point, I think expectations just become too high and you settle into some sort of sustainable rate of growth.
Can we talk about these outside moves that we've seen as well post-earnings? I know you can't do single names, but I'll tease some of them out. ARM is one, a move of something like 8% this morning. We saw a double-digit move in one direction on Meta, saw something similar on Tesla, other big tech names as well. What's the signal you take away from that?
So we actually crunched the numbers at the index level, and if you beat on earnings and revenues and increased your guidance, you were flat relative to the market the next day. If you beat on earnings and revenues but didn't upgrade your guidance, you were down 150 basis points relative to the benchmark. I mean, I think that tells you all you need to know is that expectations potentially have just become overextended for some of these names. Yes, nominal growth is robust in the United States, but as we talked about earlier, that's not necessarily going to last forever. And so I think what you're seeing are people kind of readjust to a world where real growth isn't 3% with 3 to 4% inflation on top.
So, John, I also asked that question to Peter Scheer, who had a much more technical answer. He said these things moving 10% like penny stocks, it's a liquidity problem, that people aren't really playing in this market. People have pulled back. Do you see any degree of that too?
I mean, you've definitely seen people step back from it being all about tech, and you've seen the market broaden out. Financials in particular have been behaving quite well. I think that could well be a part of it, right? Liquidity always matters when it comes to those outside moves, but when we think about more of the fundamental story, right? These stocks were trading at valuations that were simply extrapolating current rates of growth, nearly indefinitely into the future. And we all know that at some point you need to land the plane, and I think that's what we're in the early innings of beginning to see.
I love what Pete said over the weekend. 10% is the new 1% for mega cap tech. We're talking about trillion-dollar names moving double digits, which is just unbelievable. Coming up next, breaking jobless claims data just around the corner, 4 minutes away. We'll catch up with Pooja Sriram of Barclays, here to react alongside David Leibovitz of JP Morgan Asset Management. As we count you down to a little bit of data in America, equity futures down 0.1% on the S&P 500. Yields are higher by a single basis point on a 10-year, 450.82. So Some data for you, just moments away. Equities right now pulling back by 0.15% on the S&P 500. A little bit lower on the Nasdaq. We're down by, let's call it 0.2%, and round that down for you. Switch up the board and get to the scores in the bond market. Going into jobless claims, yields are a little bit higher at the longer end, up by 2 or 3 basis points on a 30-year at 466.66. And on the 10-year, 450.62, up by a single basis point. With jobless claims, Mike McKee, the estimate is 212. The number is
231. Kind of a surprise here. Remember me, I used to do economic data here when we used to have data. First data point of the week, 231,000. That is quite a change from what we had in the previous month. The continuing claims at this point look like they've gone up. I'm waiting to get the change from the revisions, and they're at 1,785,000. The initial print last week was 1,774,000. So a slight rise there. Okay, 209 is the revision to last week, so we go from 209 to 231, and we go from 1,768,000 to 1,785,000. So not a huge rise in the continuing claims number, but a fairly big proportional rise in the initial jobless claims number. But we've been here before, so we have to see if this continues.
Yeah, we have. We've got up to these levels and then dropped back down towards 200K again. But nevertheless, the question will be asked at 231 versus the estimate of 212. What is the difference between a welcome cooling in this labour market and an unwelcome deterioration? Let's turn to the price action and start with equities. We'll turn to bonds and then get to foreign exchange. Equities are positive off the back of this and now just about unchanged on the session on the S&P 500. Bear in mind where the bond market was. Switch up the board. Yields were higher by a basis point or two at the long end, and now we're lower by about a basis point on a 10-year at 448.65. So we unwind some of that move. Likewise on a 2-year, down a single basis point to 482.17. So all of this is marginal stuff. If you get to foreign exchange, I can tell you the euro is erasing losses from earlier this morning, now just about unchanged at 107.44. So, Mike, that is the question that will be on people's minds. Looking at a number that reads 231 against an estimate of 212, are we seeing a welcome cooling in the labour market or an unwelcome deterioration?
Well, unfortunately, with this high-frequency data, it's going to take you a number of weeks to find it out because, of course, it's the first time in a while that we've bounced up. Now, do we stay up? Are companies laying off more people, or is this a one-off that we have to figure out going forward? That's the hard part with this data.
I know we ask this every time, and, it feels like it needs to be asked again. What's the usefulness of initial job claims to give us any sort of signal value?
Only in a sort of aggregate over time period. On a weekly basis, it doesn't add a lot to it, but it does suggest if you see two things. A rise in the initial claims over a period of time suggests that companies are starting to get rid of workers because they see something that worries them. And a rise in continuing claims would tell you it's getting harder for people to find jobs. Now, we had this, as John said, a couple of weeks ago, and then it went away again. So you got to be extremely careful in deciding this is something that matters.
I would also add it's the highest frequency indicator we have for the labor market. And so if you're trying to keep your finger on the pulse of what's happening, it's arguably good to look at, even though it's a little bit noisy. What I think is interesting about the print this morning is, claims had kind of been sitting on one side with respect to being, very tight, running hot. You're seeing it moderate and move back in line with the broader set of U.S. economic labor market data. And so, Mike, I'd be curious from your standpoint, when you look at the U.S. labor market today, zoom out, think about all the indicators, non-farm payrolls, jolts, et cetera, where do you think we are from a slack perspective? Do you get the sense that the labor market is moving in the direction the Fed wants it? Or do you think that we're still sitting here pretty tight and there's a bit more progress that needs to be made?
Well, both. I think that we're moving in the direction that the Fed wants it. Again, it's hard to tell from jobless claims, but when you look at jobs created, when you look at the decline in JOLTS openings and other indicators, it does suggest that we are seeing the labor market come into better balance. I don't want to sound like Jay Powell.
You do.
But even at this point, 175 in jobs is still a big number.
Right.
And so balance is a better word than getting rid of a lot of slack. And we're not really sure what's happening with all the immigration into the U.S. How many of those people are going into the labor force? Seems to be a lot of them that keeps us able to hire and helps hold down wage gains. But we'll have to see.
We're light on data this week, but over the last few months, there's enough data for everyone to construct whatever argument they want to make. Let's construct a really bad one of the US economy right now. It's easy to do. Let's take the data from last week, exclude the ECI, and go to payroll. Smallest gain in 6 months. Wages, slowest pace in nearly 3 years. Go elsewhere and look at the ISM. First contraction since 2022, below all estimates in our survey. Business activity slumping to a 4-year low. Input costs going in the wrong direction. 231 on jobless claims. We're starting to see an upside surprise there too. David, we could sit here and make this sound really, really gloomy and say Q1 strength, head fake. This is going in the wrong direction. What's the counterpoint to that?
So I think that the counterpoint to that is when you peel back the layers of the onion on the first quarter GDP data, you saw final domestic demand still very robust. And so, yes, we can interpret all of this as a beginning of, a cooling in the labor market, a cracking in the labor market. But, the counterpoint that you can make to that is we're starting from a very positive position. So unlikely the consumer just falls out of bed overnight. At the same time, you're seeing business confidence begin to pick up. You're seeing CEO confidence begin to pick up. That could well lead to an improvement in investment spending and manufacturing activity this year. And I don't think you would be getting that signal from the corporate boardrooms if they didn't perceive the end demand to be there. Now, I will admit, oftentimes when you get a couple of negative prints on non-farm payrolls, the NBER comes out and says, hey, you know what, we were in a recession, we just didn't know it at the time. And so that does always exist as a risk. But I think the fact that you're hearing business leaders continue to illustrate and remind us that demand is robust gives us confidence that the economy is unlikely to roll over.
Why do you think they're fragile, though? The narrative is so fragile over the last 12 months or so. If you think about where we've been, we've had hard landing, soft landing, no landing. Started this year, we had 7 cuts, we went down to 1, we brought a few back in. Why has that narrative been so fragile over the last 12 months?
So I think that it's a relatively simple answer is that, a lot of us have never been in a situation like this before. And, we went through COVID, we went through the pandemic, none of the economic models worked, all of our forecasting was completely off. And now we're kind of dealing with this reemergence of consumers globally that, a lot of people just don't have experience with. It was just a couple of years ago where people were talking about embarking on the roaring 20s, right? We're going to have this period after the pandemic where
just for the record.
People are out and they're spending and they're consuming and it's about doing it today and not waiting to do it tomorrow. That narrative is completely faded, but frankly aligns pretty nicely with what we've been seeing over the past couple of quarters in particular. And so I think it's just unique, and that's the nature of where we are.
Let me also point out the Atlanta Fed came out with their latest second quarter GDP Now number yesterday, and it's 4.4%.
Right.
Now, it's really early, and that's really high, and that'll come down. But it is kind of funny that we're seeing signs of strength in some areas. The Fed is like a driver who's stepping on the brakes. They want to step on the brakes, but not so hard that they get rear-ended by recession. And at this point, they don't know. We're going in the direction they want because they've raised rates and the economy's slowing. How far? Did they do too much? We don't know.
Well, I think what's really interesting, if I can just jump in quickly, is if you look at high yield default rates, they've remained very low because a lot of these companies were able to term out their debt in a fixed rate fashion during the very low rate period of 2020 and 2021. If you actually look at bankruptcies in the United States, that number is rising. A lot of those businesses rely on floating rate debt. And so I think one of the things that gives the Fed a bit of confidence that, they are applying the brake in the right way is you are seeing that impact of higher rates finally begin to filter through and show up in some of the data after a period of tremendous resilience.
That is something so many people have said. Look, everybody refinanced. We're okay now. It's okay if rates, stay higher for longer because everybody took out cheap debt. But that was in 2020 when the Fed started to cut dramatically. We're 4 years out, David. Are we not finally starting to face some manner of a maturity wall?
So you are beginning to face more of a maturity wall than had been the case. I think it's important to look, though, at the share of debt outstanding that the maturity walls represent. It's mid to high single digits for both high yield and investment grade. The real issue is in private credit, right, where that number is, call it 15% over the next couple of years. Now, private credit loves nothing more than to amend and extend and kick the proverbial can down the road. So will that lead to defaults? I mean, your guess is probably as good as mine. But what you've seen, and now particularly with the bank loan market heating back up, right? There's competition to do deals, and that's allowing people to address the higher interest rates we're dealing with today and not have that become a problem until some point down the road.
Well, then you get the scary thing of private credit to compete with the banks. All of a sudden has to make these concessions, not charge as high as fees. So are we in this environment where banks are coming back in, private credit has done an extend and pretend? When the music stops, what does that look like with a non-transparent and somewhat unknown entity?
So it looks completely different than what we went through almost 15 years ago, because at the end of the day, the people on the hook are investors. And I'm not saying that makes it okay, but if you think about who invests in private credit, it's pension funds, it's endowments and foundations, it's high net worth individuals. And so it would be unfortunate if all these funds had a problem and people began to lose their shirts. But people who try to draw parallels to what happened in 2008, I just think it's apples and oranges.
If you are just joining us, welcome to the programme. A rare upside surprise on jobless claims about 10 minutes ago. Came in at 231. As we like to say on this programme, the wrong kind of upside surprise on claims. 231 against an estimate of 212. Going into the opening bell about 50 minutes away, futures were negative. Then they turned positive, just about unchanged on the S&P 500. Yields were higher. Now they're lower. We're down 3 basis points on a 2-year at 4.80. In the FX market, the dollar was stronger. Flips weaker. The euro, 107.55. The euro now positive by 0.1%. Mike McKee said it straight out the gate. We haven't seen much of Mike because there hasn't been much data so far this week. This was the first data point. Tomorrow, we'll get UMich consumer sentiment expectations. Then, Mike, the big ones next week, PPI, CPI, US retail sales.
Yeah, we put it all into 1 week to make it more exciting. We're looking for a slowdown in inflation, and that's going to be the big story next week. And we'll be watching every day to see what Fed speakers have to say about that. Retail sales is very interesting. You got people who are all over the map on what's happening with sales. You've got a lot of notes from people saying retail sales have slowed a lot. Bank of America out this morning saying that not only are retail sales holding in, they're not saying they're growing hugely, but they're holding in, but that they're seeing at the lower end of the income scale, which everybody's been talking about. The poorer people are all out of money, and so they can't spend anymore. That's not what Bank of America is seeing.
Let's talk about the setup. Can I just get into the setup for next week? Last week, we were talking about asymmetric risk. And what people were saying basically was that if the data's hot, yields won't rise too much because the Fed's not going to hike. But if the data's weak, yields can drop a whole lot more because this Fed wants to cut. That was when yields were at 5% on a 2-year. We're down to about 4.80. We've reset a little bit. Is there still asymmetric risk around this story into next week?
I think that there is, because if you look at the positioning data in particular, there is a massive short position sitting across the rates market today. And so I think part of why you saw rates come down so sharply in the wake of last week's non-farm payroll report was really just people adjusting to, okay, maybe the economy is getting a little bit cooler. Maybe we shouldn't be betting on going to 5. Maybe it's more reasonable to bet on going to 4.30 or 4.25. But to me, I always come back to where the MOVE index is, because it's important to think about volatility and what's being priced there. Yes, we've come off the boil, but we're still at elevated levels. And what that represents to me is simply a wider dispersion of outcomes. Again, back to where we started the conversation at the top of the hour, last week had some for the bulls and some for the bears. And so I think we just need to see more data, particularly this CPI print next week, to get a better sense of the broader direction.
I'm trying to do what I can for both sides.
Very kind of you, Mike. Can I take that same sort of logic, though, and apply it to equities? It was Michael Hartnett who, before the jobs print, basically saying if it's low enough, then it brings the stagflation fears. So in that way, bad news is bad news again. We got a lower print. We got a higher print for the jobless claims, yet equities, they're up. Are we not worried about that environment?
Eventually we will be, but I think we're still in the early innings of seeing the data really cool in the way that the market wants it to, and the way that the Fed has been suggesting they would like to see it as well. We were chatting the other day. Yes, at some point here, bad news becomes bad news, but if you look relative to history, 175 payroll growth certainly isn't bad. 4% wage growth certainly isn't bad, and an unemployment rate below 4%, that signals a pretty robust labor market situation.
David, you're going to stick with us. Listen to these numbers. Bank of America Institute numbers are just out. Take a listen to this. Lower income household balances were 67% higher than the 2019 average at the end of April. Middle income household balances 58% higher, and higher income households 45% higher compared to where we were back in 2019. Those numbers are absolutely staggering. More on that a little bit later. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. We're going to stick with real estate here because approximately 1 in 37 homes in the United States are now considered seriously underwater. Nationally, 2.7% of homes carried loan balances of at least 25% more than their market value in the first few months of the year, and that's up from 2.6% in the previous quarter. Kentucky, Mississippi, and Oklahoma saw the biggest increase in homes seriously underwater. And living in Manhattan is also getting more expensive. Apartment rents rose to a new high for April. Leases were signed at a median of $4,250, up $9 from the same time a year ago, according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. Rents have climbed annually in 3 of the past 4 months, suggesting another record-shattering summer to come. And shares of Airbnb are falling in pre-market trading. The company posted revenue that beat analyst estimates but provided lackluster guidance for a second consecutive quarter. The company, which specializes in shared homes and vacation rentals, says it sees growth before slowing an uptick in summer travel. It's expecting revenue growth to re-accelerate in the third quarter, though, as key international events like the Summer Olympics in Paris and the Euro Cup in Germany fuel travel demand. And that's your Bloomberg Brief, John.
Shonali, thank you. Appreciate the work this morning. Thank you very much. Up next on the program, back to the bundle.
The other positive for us is obviously the streaming service. We're encouraged by the progress we've made in that business in a relatively short period of time.
That conversation is coming up next. Just moments ago, jobless claims coming in at 231,000 against an estimate of 212. Your equity market recovering just about unchanged on the S&P. The opening bell, 45 minutes away. We got jobless claims data moments ago. It came in at 231,000. The estimate was 212. That is an upside surprise, the wrong kind of upside surprise. And off the back of it, equities erased the morning's losses. We are just about unchanged on the S&P. Yields were higher. Now they're a little bit lower, down a basis point on a 10-year to 4.4845. Under surveillance this morning, it's back to the bundle.
The other positive for us is obviously the streaming service. We're encouraged by the progress we've made in that business in a relatively short period of time. We took prices up a little bit in the beginning of this year and didn't really see much of an impact. But we do believe that the great experiences we provide, people are willing to pay for.
So here's the latest. Disney and Warner Brothers Discovery announcing they will combine their streaming services into one bundle starting this summer. Subscribers will have access to Disney+, Hulu and Max, both the ad-free and ad-supported versions. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, we've talked about this for years now. The bundle's making a comeback, and I guess here it is. What's the price point of this?
We don't know the price point just yet, John, but yeah, you're absolutely right. What was old is kind of new again, right? And it's all about now creating the super bundle. For Disney and Max, this kind of makes sense. I mean, both their products together will definitely have 4-quadrant appeal. And I think, why we're seeing this, I mean, there is a kind of a hint of desperation here from all of these media companies, because we know that streaming subscriber growth has kind of hit a wall. I mean, Disney is not really able to get beyond that 150, 160 million subscriber mark. And then if you kind of look at Max, which has been fairly successful, they've really struggled to get past that 100 million mark. So this is about kind of reinvigorating that subscriber growth, but more importantly, curbing churn. Because one thing with streaming that we know is it's really easy to cancel your service, and they're hoping that this way they can kind of keep customers on the bundle.
Geetha, as Danny mentioned earlier on this morning, it's not just this effort. We're seeing it in sports as well. As you look at the companies that are combining, what is bringing those specific companies together versus, say, tie-ups with others?
Yeah, so, this particular instance, John, with the Disney Warner Brothers is actually, I think it's perfect timing, because it's kind of a good setup. You mentioned sports. Both these companies, along with Fox, have that sports joint venture. So they do have a streaming product coming out a little bit later. They have now this Disney Plus Max product. Then they have the sports product. It kind of eventually sets up a path for them to have that super bundle, if you will. And I think that's kind of what they're aiming for here. And so far, what we've seen with bundling is that it does work. So Disney itself has said that about 40% of its streaming subscribers actually take the bundle right now. So that's, the Disney bundle with Disney Plus, with Hulu, and with ESPN Plus. So bundles do work. And that's kind of what they're they're betting on here.
What about the math of how it works for the company, Geeta? We learned that Warner Bros. Discovery wants to cut costs, wants to raise some of its subscription prices. What happens then if you need to offer a bundle and need to price it competitively to be the super bundle?
Yeah, I think they will. So this partnership here is a little bit different from what these companies have been pursuing. So what we've seen across up until this point has really been bundles more with the telecom providers. So we know like that we had that big Verizon bundle where you had, Verizon was offering kind of the bundle with Max and Netflix, multiple telcos. You had T-Mobile with Netflix. There's obviously a revenue share agreement here. Obviously, what these companies are trying to do is by doing it themselves without a telco partnership, they're obviously trying to keep more of that profit for themselves. But yes, ultimately, it is going to come down to cutting costs. And this helps them to kind of really cut down on marketing costs. Because if you look at just marketing costs for all of the streaming subscription services, apart from content, marketing and selling expenses are actually one of their biggest cost centers. So this really helps them with that when they kind of pool their resources together.
And that's actually a perfect segue into the question that I wanted to ask. We've talked about subscribers, we've talked about price, we've talked about costs, but content is king in this space. And so how competitive do you think this bundled content will be relative to the other folks that are in the market?
I think that's absolutely what they're betting on. Disney obviously has its own appeal with younger children. HBO Max, as you know, is prestige TV. They're really kind of, and then Hulu right now is kind of getting into more edgy entertainment. And then with Max, remember, you have a whole bunch of movies that are going to come on the service, as with Disney Plus, once they release in theaters. And so that's really kind of what they're betting on here. I mean, you have two superpowers in terms of content IP, in terms of storied brands. And so they're really kind of betting on getting, those brands together and appealing to a much broader section of the audience.
Geeta, this was great. It's always great to catch up with you. Geeta Ranganathan there, Bloomberg Intelligence, on the latest streaming effort, trying to get our hands around just how strong this consumer is. I want to go back over those numbers from Bank of America and their Bank of America Institute research piece. Lower income household balances 67% higher than the 2019 average at the end of April. Middle income household balances up 58%. Higher income households up 45%. David, can we talk about this? Obviously, the month of April can be skewed by, say, tax returns. But where is this US consumer? It's something we grapple with every single day. Jobless claims tell you one thing. You look at overall payrolls growth, it tells you another. You hear from Disney and the theme park business, everything's fine. McDonald's, Starbucks, we got a problem. Where are we?
So I think that the consumer is in a period of transition. And, when we look at the broad swath of data that we have access to, one of the things that you are seeing, particularly among lower income individuals, is trading down. Right, so not buying the name brand of, say, paper towels or detergent, so on and so forth. But people are still very much valuing experiences, because it was experiences that were taken away from them during the pandemic. And so you're seeing a lot of spending continue, but the underlying profile of that spending has, in our view, shifted. I think what's particularly interesting about the lower income individuals, it all comes back to the labor market. If you want a job in this economy, you can go out and get a job. And if you look at the data from the Atlanta Fed, as to where wage growth is most robust, it's still in those lower income buckets. And so these people, the cash is coming through the door. Given their higher marginal propensity to consume, they don't save it, they don't invest it, they go out and spend it. And that's what's keeping the whole thing humming along.
And not only is what they're putting it in changing, but also how they're doing it. Sure, they can get jobs, but at the same time, the pandemic savings is run out. John and I were talking about this earlier. Buy now, pay later. A Harris poll found 43% of those who owe money to buy now, pay later said they were behind on payments. So as we get people shifting to this type of credit, sure, they're still spending for now, but when does the music stop?
So I think you're beginning to see that stress build, and I think it's all part of a broader story. And we talked about this a little bit earlier in terms of small businesses and floating rate debt, and that finally beginning to pinch. That you have seen delinquency rates on credit cards and auto loans rise here. One of the things that came out of the great piece that you all put together on buy now, pay later was a lot of the folks that are engaged with those services also tend to have credit cards that are all kind of tied in together. And so you're seeing that leverage profile begin to build. And that's something that we're watching. I think that the conversation is shifting here from, okay, it looks like the economy may cool off. How much cooling are we going to see? And the big risk is if we see people continue to get over their skis, if you see consumers continue to lever up, if you see CEOs become increasingly confident and go for those capital expenditures, if you see vehicle sales, housing, right, the cyclical parts of the economy, if that begins to heat up, we're going to get a little bit nervous.
David, this was great. Just fantastic to have the hour with you. David Leibovitz there of JP Morgan. Bramo warned you at the start of the week. This week might be a little bit boring. Last 24 hours was 187.70 at the close on Tuesday, and then the close yesterday, 51.87.67. We've barely moved. Things are getting a little bit more interesting going into the weekend. Tomorrow morning, here's the lineup. Former House Speaker Kevin McCarthy will speak to Jim Bianco of Bianco Research, Anastasia Amoroso of iCapital, and Dan Suzuki of Richard Bernstein. Danny's going to be back tomorrow. We'll do it all again from New York. This is Bloomberg.